discussion? So, seeing none, as soon as we get a motion button up, we'll move consent. I'll make the motion, seconded by Tanasi Provolos.
Ready to vote?
Use my title, the man, the myth, the legend. It's up to you.
All votes are in.
And that motion passed 9-0. Okay, we're going to take the agenda a little bit out of order today. We got a couple of items to get through. So what we're going to do first is go to investments. So I'll give it to Bill. We have an item in investments that we're going to handle now. It'll be investments item number A2, I believe. Yes, A2. So, Bill.
We have a securities lending, an options program that we're taking a look at. And yesterday, the investment committee met on that, and we voted 5 to 2, to bring it to the board today.
3 to 2.
3 to 2, yeah, 3 to 2, sorry. So now it's coming to the board, and you can hear it, and we can all decide as a board where we're going to go with it.
Okay, so we had a very lengthy discussion on this strategy yesterday, and what I would like to do today is have Anders give a brief summary of the strategy and how it fits in the portfolio. Then I'm going to address some of the operational due diligence concerns that were voiced and make some general comments. And then we will turn it over. We have representatives from Allianz here today to answer some of those due diligence operational concern questions and answer any specific questions to the strategy. So with that, I'd like to turn it over to Anders.
Thank you. So this Allianz strategy consists of two components, a beta component and an alpha component. So the beta component provides market exposure with no management fee cost to SDCERS. So the market in this case is the S&P 500 index return. The alpha component consists of 3 different option spread strategies that are meant to provide excess returns in up markets, down markets, and sideways markets. And the excess return component of this strategy also has a very low correlation to our other strategies within the U.S. equity portfolio. So that provides a nice diversification benefit to the equity asset class. In this slide, we're going to talk a little bit about the active risk component of the total fund. So active risk is typically it's a type of risk that a fund or managed portfolio will create as it attempts to beat the returns of the benchmark which it is compared to. So the more a portfolio diverges from its benchmark in terms of holdings and style, the more active risk you will see in the portfolio. So right now, we have about 0.5% of active risk in the portfolio, and the board has approved a max active risk of 1.75. So you think about 0.5, that means that in 67% of the times, the portfolio will be within plus minus 0.5% of the benchmark. And if you look at the U.S. equity asset class active risk, currently we're at 0.94, and with the addition of this strategy, we would be going to about 1.18. So not a huge difference, but a little bit of a difference. And what this will do as well is it will provide the opportunity for the total fund and the U.S. equity asset class to capture some of the excess returns that we've kind of moved away from with the increase in passive management over the last couple of years. So one of the most important things I think about the Allianz strategy and what it will do to our U.S. equity asset class is that it will reduce our reliance on the small cap bias that we currently have within the portfolio. So as you can see by this slide, which I think is an important slide, is if we don't add the Allianz strategy, we have about 45% of the portfolio as the small cap bias contribution to active risk. If we add the Allianz strategy into this portfolio, that goes down to 21%. So the Allianz strategy acts as the diversifier within this. So we have 2 sources of active risk instead of just one being the small cap bias. So now, and those 2 active risk sources, the Allianz strategy and the small cap bias, have a very low correlation to each other as well. That's one of the diversification benefits of this strategy, I think. So with that, I'd like to turn it over to Liza.
Sure. I'd first like to address some of the operational due diligence concerns that were voiced yesterday, and to give you a little bit of flavor for the due diligence that's been done on behalf of the consultant as well as staff. Aon Hewitt has conducted over 20 meetings with Allianz over the course of the last year. So they're in very close contact with the manager. They also require the manager to complete a 36-page due diligence questionnaire. In addition to that, they also have a separate operational due diligence team that goes and conducts their own research on operations. In addition to that, they have to fill out a 16-page, very rigorous questionnaire for that team. Staff has conducted on-site due diligence with the manager, and we've had 2 face-to-face meetings in the last year and over 5 calls on the strategy, including calls to references. So I think we have completed a very thorough and complete due diligence process on this strategy. And with that, I'd like to turn my comments more to a high level. So why do we like this strategy, and what does it add to the portfolio? 1, diversification. This strategy has a low correlation of returns to other managers in the equity portion of the portfolio. 2, it reduces the active risk from the small cap bias. And as you will see when I go and talk about performance of the total fund portfolio last year, the small cap bias significantly hurt us. 3, this increases the active risk in the equity component and the total fund portfolio. That is something we've been talking about for a while, and that is something that we want in the portfolio. It does not increase the standard deviation of the portfolio, since it is still considered as part of the equity bucket. The total fund tracking error moves from 52 basis points to 62 basis points, which is not a significant increase in tracking error. And 3, and potentially the most important, is this gives us the potential for excess return in the portfolio. Anders has modeled the U.S. equity class returns with and without this strategy for the last 1, 3, and 5 years. And if we had had this strategy in the portfolio, it would have added, on average, in the U.S. equity class, an additional 60 to 80 basis points of performance. That is not insignificant. We believe that this is a unique strategy that can add significant value to SDCERS' portfolio, and that's why we've brought it forward to you today. I realize that options trading strategies may be unfamiliar to some of you. They are not to me. One of my first assignments back in the olden days, in the early 80s, when I started in the business, I was 10 at the time, was to manage a covered call trading program at St. Joseph Bank and Trust. These option strategies and options as an instrument have been around for a long time. They are very liquid, they are standardized contracts, and they're traded on an exchange, so you do not have counterparty risk. And with that, I would like to turn it over to representatives from Allianz, who will give you some further color on the strategy. Thank you.
Thanks, Liza. Thanks, Anders. Good morning, SDCERS board. As I said yesterday, it feels good to be back in this chair. My name is Amanda Montgomery. I'm with Allianz's Institutional Client Service team. And this is my colleague, Jeff Sharon. He is part of the Structured Alpha team. He's a product specialist on the team for the strategy. So he can answer any detailed questions you might throw at him. What I thought might be helpful, though, is to address what we heard were some of the maybe not completely answered questions yesterday and or concerns. And there were 4 areas, some of which Liza's just touched on. around due diligence, the potential operational risk controls and complexity of this strategy versus some of your other traditional equity managers. Compensation and fee structure, which was a great question Christina asked yesterday. How do you, Jeff, on the team, get paid? Which you should ask of all your managers, I think. So we're happy to address that. And lastly, just making sure that this is a strategy you all would feel comfortable simply, briefly explaining to your constituents. Would my mom understand it if I told her this is what Structured Alpha does? Any questions before I start there? Okay. On the due diligence side, Liza talked through some of the due diligence, but I thought it might be helpful to walk through a bit of history too. Your staff has been looking at this strategy since 2010. I know because I looked at the strategy and I thought, that's different, it's unique. It was also compelling, and took it to Aon Hewitt, your consultant. Since then, this strategy has been due diligenced by many, many major consultants. It's a high conviction strategy for not only Aon Hewitt, but other clients we have with Callan and NEPC. And I can tell you that the rigor of the due diligence they do, especially on anything that is a little bit different, is extensive. So I think you should take comfort there. It also, back when I looked at the strategy, had not nearly as many assets under management as they do today. We talked about yesterday that some of the strategies within Structured Alpha will actually soon be closed to new clients. I also wanted to just note, in the way of due diligencing the behavior of the strategy, I think if you even look at the last 12 months, we have certainly been through a variety of market challenges and environments where the strategy has performed, and Jeff can certainly talk to those. A great example I just went through with a client doing a Q2 review was, here we have a year, January, and the market goes down 10, and it comes back up 13% in March and April, February, March, and the Brexit kind of flash crash, if you will. What did our Structured Alpha portfolio do? Well, it did just what it was supposed to, and its returns were fine. And let's take the Brexit example. In that case, what did your traditional equity managers do? Well, they went down, and they came back up with the market. Structured Alpha performed well as well. But the question was, well, what if the market went down? What if it had gone down further? What if it hadn't come up? Our other equity managers would have been down that amount. How would you have been performed? Well, they would have added value in the alpha portion, because it's different, and that's the uncorrelated excess return that you're looking for when you blend and mix your managers. So for you all today, this would be sourced from your BlackRock S&P 500 beta exposure. It's part of the plan's tenants to get broad market exposure as cheaply as possible. So you have that mix of passive and active. Do you believe that you can add, so you're going to get that, whatever the S&P 500 does, plus the excess return, and the way that Structured Alpha goes about getting that excess return, yes, is different from some of your traditional equity managers, but that's what makes it unique and compelling. On the operational complexity front, I think Liza covered some of those issues. Yes, we do acknowledge that it is different in the way that your traditional stock pickers and a Dodge and Cox may be getting their excess returns that you hope they give you over a full market cycle. But that's what makes it unique and compelling, and we have spent years building those investment models and risk controls. These are, as Liza said, all listed, exchange-traded options. They're very, very liquid. There's no counterparty risk. And you do currently hold these instruments in your portfolio today and have for many years. If you look at managers like PIMCO or other derivatives in your overlay program, so they are not foreign to your portfolio. I also thought it was worth noting the Structured Alpha strategy sitting within the context of Allianz Global Investors and our corporate structure. We think that should give you a level of protection against common operational failures, just given Allianz Global Investors, $500 billion global firm. We are owned by Allianz SE, as is PIMCO, one of the world's largest and oldest insurance companies who've been in the investment management business for over 100 years. So we have separate legal, operations, compliance, finance, PM reporting lines. We have independent oversight and performance oversight of this strategy. The next point was around compensation and fee structure. Karina had asked how are the PMs paid, and Jeff went right into the bonus portion, stating how they're aligned because they don't make money unless you make money, because the management fee on this strategy is zero with only a performance fee. But just to flush that out and make that a little more clear, everyone at Allianz is paid a base salary paid by the company and then a bonus piece. That bonus piece for me is discretionary. It has nothing to do with whether you buy Structured Alpha today or not, or how it performs. For the investment professionals and someone like Jeff, it's much more formulaic, so it does depend on how the strategy performs. That bonus piece, then, you only get a portion of it in the year that it's paid. Another good portion of that is withheld or deferred for 3 years. It's divided and split into a portion that will be paid out based on how Allianz Global Investors does, and another portion where we can choose the Allianz funds that we invest in. Jeff chooses to invest in Structured Alpha, as does the team, because of their confidence and conviction in it. So I just wanted to flush that out a little bit more because I didn't think we adequately addressed that yesterday, Karina.
And that's 1 and 3 year rolling return basis.
Can you answer that?
Yeah, for the firm performance, it's a 3-year compounded annual growth rate. For the actual annual calculations, it's just strictly a revenue share based on that year's realized revenues. And those revenues are 100% derived from the performance fees. So there needs to be outperformance to generate revenue and to therefore generate variable income.
So let's talk a little bit about the fee structure, which is a zero management fee and 30% performance fee, and one that has been very well received for our clients. It is a little bit uncommon to see that in our industry. You're more likely to see 2 and 20 or a higher base fee. And I would say that comes from probably early pricing of the strategy and getting clients in and saying, we have so much conviction in the way that we'll perform. We're willing to work for you for a 0% management fee and only work for the upside. Also, the nature of this strategy is very different than, say, a Brandis that's in your portfolio, who may add value over time, but they do need time in those market cycles to do that. So you have been with Brandis for many, many years. They have added value, but they have gone through at least 2, maybe 3 periods where they've underperformed for 5 up to 7 years. And you've still maintained that conviction in the portfolio. And I think that was one of your concerns, maybe, Karina, is if you're underperforming, all managers go through periods of underperformance, is the team not getting paid? Would that incentivize them to take on more risk? And that's just not the case. And the nature of this strategy, a market cycle for them is more like 4 months with tiny little singles in a very risk-controlled way. So on a year where they have not outperformed the S&P 500 and added value, added that alpha, Anders and your consultant, trust me, are going to be asking and knowing why. And that is not going to go on for multiple years like it might with some of your traditional managers. The last point was just in can you explain this to constituents? It's not, maybe it's, it's definitely different than the dodging clocks, choosing whether to buy Coke or Pepsi in adding their additional alpha. So in one sentence, I would say Structured Alpha Equity 500 will deliver the return of the S&P 500, plus it aims to deliver excess returns regardless of market conditions. They don't care if markets the S&P goes up or goes down, using listed index options in a unique way to pursue risk control return profile.
I think I would add on that the fees are based on the performance on the alpha component, not the beta component.
Correct.
Correct.
Bill or Tanasi here in the queue there?
Yeah, I mean, first of all, any strategy that has alpha in it is really cool, so I'd probably vote for that.
It's a terrible name.
The only thing that's stopping me is that Jeff has been sweating profusely, and I'm a little concerned that he's either going to suffer a coronary or perhaps the whole story hasn't come out. But the question actually that I have is if we have these, first of all, I think it's what, 200 million. So what is that in terms of percentage? What is that for our entire portfolio? 3%. Okay. And second issue is if we already have these products in our portfolio in other places, how are we making sure that we don't creep beyond the 3% or beyond what the board thinks is an appropriate percentage?
Not in the same way you don't. So I just mean an option.
Oh, sure. You're not a
security.
lawyer,
The
but you're double
security
talking
itself.
me. Sure. Go ahead. No, please. I'm sorry. Go ahead.
An option as a security you have in your portfolio. Nothing like the way that this strategy takes those options and puts them together in.
No, I appreciate that, but I'm just saying, as to options in general, we carry options in the portfolio. How are we?
We don't have any limits
Okay.
on that.
Maybe the question is, should we have limits, and should we be collecting data on what's going on elsewhere in the portfolio compared to this, so that we understand what our total exposure is to options? I'm not opposed to options, by the way. I'll try anything once, sometimes twice, but
We can have the consultant take a look at that. To me, it'd be like, well, do we have too many stocks in the portfolio? So, I mean, to me, options would be the same as stocks or any other listed security. So, from my perspective, that's not a concern. We can certainly look at it, but the options that are in the PIMCO portfolio are completely different than what these guys are doing.
okay, so there's no chance of overlap, or that we have options working in opposite of each other, or things of that nature.
I highly doubt that, and even if there is, PIMCO's pursuing a different strategy, and that's perfectly okay.
Thank you.
Ed?
I would like to hear from the two committee members who voted no yesterday, the reasons that you voted no, and also whether concerns that you have now been addressed by Amanda.
Maybe I'll go first here. So one thing I think would be helpful to the committee is to have Jeff speak to pages 12 and 13 in their presentation, and it'll give you an idea of what's involved in the options hedging strategy, because that's actually how they carry it out. So Jeff, if you could speak to those two pages and just give the board an idea of how you do this.
Sure, I'd be happy to. So if you look on page 12, this is one of the core position types. We have 3 position types in the portfolio. This is an example of a range-bound spread. An option spread is just a combination of different options and to achieve a given, what we call, payoff diagram. And here the payoff diagram is the dark blue. The dark blue is the range, the trading range, wherein we will profit at expiration of options. Options all have an expiration date. In this case, it's 49 days, so 7 weeks to expiration. We've built a position that will be profitable if the S&P 500 remains within +7 to -12% over the next 7 weeks. That is a pretty wide range. It is non-directional. We don't actually care. We can profit if the market goes up or down. In fact, the zone is bigger to the downside. So in many ways, down would be an even better scenario for us. But we're really indifferent as to the direction of the equity market. We just want, for this one position, we want the index to remain within a range. And if it does, what actually happens is the options we've traded, we have sold options. They expire worthless, and the premium, the cash that we collected at inception becomes ours to keep as a realized gain if the index stays in the dark blue over the next 7 weeks. So that's a very high probability position. We can quantify that probability based on our statistical analysis that we do. It's about an 88 or 89% probability of success. What I'm implicitly telling you is that there's a an 11 or 12% chance that this zone will not hold. So we know this, and it's part of our process to anticipate that sometimes the market will not behave according to the probabilities. And that is why we have two other types of positions. The second type of position is a directional spread. Now, in a directional spread, we're combining options in a way such that the dark blue is in much different places. Okay, here we need the S&P 500 to make a move, up or down. Once again, down is actually a slightly better path because the dark blue zone is bigger. But we will not make money on this position unless the S&P makes a move, and especially to the downside, it would need to be a big move. We need the market to go down, probably there it is, from -5 to -16%. Over the next 7 weeks to land in that dark blue. That's the only way we'll make money on this position to the downside. So it definitely needs to move down. Now, what's interesting is on the range-bound spread, we need to take action at -12%. If the market goes down beyond -12, we need to change this position. There'll be a slight cost involved with doing that. But at -12, we're making money on the directional spread position. So the notion of having positions counter to each other is actually a big part of our strategy. It's diversification for us. So at the very time we're spending money to restructure some of our positions on the range bound, we could be making money on directionals. That plays out in that way very frequently when there are big market moves. Brexit was the most recent example. And so the combination of those two positions is very powerful. And then ultimately there is a third type of position called the hedging positions, which are in place for more a market crash. So what I've described already are market moves that are, multi-week in nature, pretty normal. They can be bigger than you typically see, but they're normal, orderly moves. What we're talking about with the hedging positions is an absolute market crash, a severe move to the downside. Typically, we cite the October 1987 scenario where the S&P 500 is down 20% in a single move. The market is closed, and that's really important because when we restructure some of our other positions, we're presuming the market is open and orderly. But if we get a market crash, the market is not open. It is not orderly. You cannot trade. You wake up the next day and the profit or loss is what it is, and there's nothing you can do to change your positioning along the way. That is why we spend a fair amount of money to buy these hedging positions that will protect the portfolio such that if October 87 were to happen, we would likely be flat with the equity market or actually be adding a little, meaning, if the market's down 20, we might be down 18. It really depends on how much option prices move, but we will be protected. We will be in very good shape relative to the index if we get into the crash scenario because of these positions. So those are the three types of positions. Each one is modeled very carefully, but really what we care about is the interaction among all three, and it's the portfolio effect that we care about. So in some cases, we're really focused on return, but more often than not, we're extremely focused on risk control, and that's really the key to this strategy.
So the hedging, it's like an insurance policy. You actually buy a hedge against and so is it possible that hedge that you bought won't cover it all?
Yes, I will tell you, hedging is expensive and it doesn't hedge everything. So we have to be very careful. What we find is that if the market goes down 7, 8, 10%, which is a typical correction, that's okay. We can trade through that. Maybe we will lose a little bit of money in the short term, but over a 3 or 4 month period, we would expect to be able to benefit from an environment like that. So we're not so concerned about hedging every negative move in the markets. The ones that are orderly and are reasonably typical, we can handle with the natural rotation of our process. The ones that are more distressing to us, or maybe to many investment strategies, would be what we call that tail event, where the market is down in such a severe way and you can't even trade. I think a lot of strategies out there will say, well, we have a stop loss at -5%, we reduce our risk. Well, that's not really true. If the market's closed, you cannot take a stop loss. You need to be protected before the fact for certain types of risks. And we are. And the risks that we protect against are the ones where we feel that they are, truly a distressing situation to try and overcome were we not to hedge them. Everything else, we believe we can manage through quite capably.
So the reason I wanted Jeff to go through that, and he's brilliant with it, is that there are long puts, long calls, short puts, or short calls, long calls. This is a complex strategy that I don't know that any one of us here understands kind of how this is done, but I understand what the results are. So in a way, that bothers me a little. I think when we go into traditional active managers that are managing large cap funds, Dodge and Cox, we kind of know what they're doing. We know companies and how the market moves, but this, we don't really know the internal workings of it, and we won't until something happens. That's one thing. So the other thing, another issue I've got is this is a very small percent, 3%. But I think to me, and I brought it up yesterday, there's kind of an opportunity cost. I would rather see this in areas where I think we can perform better if I'm going to commit $200 million to something than this particular strategy. This to me is more like an insurance strategy that might perform a little better than the 500 for us one way or another, up or down.
Well, could I don't mean to interrupt. I'm sorry. Is it okay if I interrupt?
Sure, go ahead.
Yeah. Just to be clear on that, this is an equity strategy because the beta is going to drive the returns, not the alpha. The alpha is going to enhance the returns ideally. And it has been a top percentile equity strategy, number 1 percentile. It's the best equity strategy out there based on the eVestment peer rankings. So I don't think there's an opportunity cost. I think if anything, this has been hugely helpful to our clients who have invested in it in an equity context. I think the frustration for many of our clients has been that traditional stock picking strategies are hard to find good ones that consistently outperform, whereas this has been a lot more reliable and stable for them. So, I just thought I would, if that adds color to that thought.
Yeah. So in other words, this really does belong in the large cap equity area,
Absolutely.
not the
Absolutely.
opportunity area.
Absolutely. And I think
Yeah.
what you're talking about, and the way you're saying opportunity costs is, as we said, is more of an asset allocation decision.
Mm-hmm.
Right? This is not changing the structure of your U.S. equity holdings.
Right.
And what you have decided is at a large asset allocation that, that's the percentage we're going to hold in U.S. equity. And this is simply saying we would like to add a large cap U.S. equity manager, active manager, because we think that they can add a little bit of value over the S&P. And you have a number of other managers where you also have that conviction and belief. And the beauty of this is that it is further diversifying those existing active managers because their source of alpha or excess return is obtained in a different way.
Then another question is that I think you started this around 2008, was it? 2005
This specific application in 2008, but 2005.
2005,
Yeah.
yeah. And you've got about close to $6 now, $6 billion. And overall, Allianz has got $500 billion or something under management. So it is a relatively new area for Allianz and for pension managers to be looking at. How many, could you go through your pension clients, kind of how many? I know you have one large one. You mentioned Arkansas yesterday and another one. Could you just kind of give us an idea of who's doing this?
Yeah, I'd be pleased to. So we have about 60 clients, mostly U.S. pension funds, almost exclusively DB plans, and they among the public funds segment. We have a number of state funds, Alaska Retirement Management Board. State of Vermont has been a client since 2008. Arkansas Teacher Retirement System has been a client since 2007. The city of Milwaukee hired us about 2.5 years ago. And then on top of that, we have a number of corporate pension plans and Taft-Hartley pension plans as well.
And I guess a question for staff is, did you do the due diligence in talking to some of the other funds to see how they
Yes,
were
yeah.
felt
I
about-
spoke with Arkansas teachers and Blue Cross Blue Shield, just to give you a little bit of color there. Arkansas teachers, total AUM in their plan is $14.7 billion. They have two of the structured alpha products, one the US 250, which they have $115 million in, and then $560 million in the US 500. Blue Cross and Blue Shield has total assets of about $11 billion. They have been with them for about 5 years. They have $2.3 billion invested across 6 structured alpha products. Both of them were very complimentary and made comments like, this is a unique strategy. It's predictable, it's repeatable, and it's very risk controlled. It does what it's supposed to do, and it's added value.
Okay, that's kind of my questions. Karina?
Yeah, hi. So the investment objective for the strategy is S&P plus 500 basis points. And the performance fee kicks in at anything above the S&P 500 return of 30%. That's the performance fee. Do I have that right?
Yes, you do. That's correct. And I would just add there's a cumulative high watermark. So if ever there's a period of underperformance over a quarter, we have to earn back the underperformance and get you back to the highest level you ever were on a relative basis to the S&P before we can ever charge a fee thereafter.
Okay. Reading from the Aon Hewitt report at the bottom of page 5, I want to make sure that you also agree with this. The strategy utilizes S&P 500, Russell 2000, and NASDAQ 100 index options to create these spread combinations. And the allocation mix among the 3 indices is roughly 55% S&P, 30% Russell 2, and 15% NASDAQ 100.
That's
fairly
correct.
consistent?
Actually, in the past year or so, the S&P allocation has come up a little bit higher, closer to 2/3 or 3/4, but directionally, that is correct.
So obviously, if we were to invest in the beta passively, I mean, we would pay just a handful of basis points. So I just want to make sure that we understand what is alpha and what is beta. You also talked about the indexed, or the enhanced equity managers. Have you, or do you have, or can you show or provide to us the tracking error quartile? So in other words, how does your strategy compare to peers on a tracking error basis? Because I want to understand, are those sort of enhanced passive managers in there with a much lower tracking error?
Right. No, that's an important point. It's not just about return, it's about risk, certainly. I don't know the number off the top of my head. I will tell you the tracking error in the early part of the strategy's life, the first 6 years, was close. It was in the 5.5% range, roughly. In the last 5 years, it's been, and as we talked about yesterday, we made some risk control enhancements to bring the tracking error down. The tracking error profile has been, since January of 2012, has been about 2.5%. So without knowing the numbers off the top of my head, I would tell you that is probably above median in terms of having lower tracking error than the category average.
I would also like to ask about, is there any sort of preferential treatment given to other investors for liquidation?
Oh, absolutely not. So everybody can come in on the first of a month or out on the first of a month. These are commingled fund structures where everybody has identical terms, and the only provisions we provide in side letters pertain to ERISA plans that require us to affirm our fiduciary status, which we use the fiduciary standard of care for all our clients, whether they are subject to ERISA or not.
Are there other clients that may have separately managed accounts that may have preferential treatment?
There are not. Every single one of our 60 or so clients is invested via these commingled LLCs.
And can you talk about your use of implied versus historic volatility and the rationale for using historic?
Sure. So implied volatility is a very important measure in the world of options. It is effectively the price of options based on the sentiment that people feel about the risk of an equity market move. It is very important. However, it is subjective, and it also only goes back to 1985. In our analysis of the behavior of equity indexes, we like to go back to we actually go back all the way to 1929. There is no VIX analysis going back beyond 1985, so we use a synthetic VIX that we created that I think other managers do similar types of exercises using historical realized volatility observed. You can apply a spread to that, and you can estimate what the VIX would have been had it existed going back many more decades. And the additional length of our statistical analysis time frame is very important to us. We have seen market moves, for instance, in 2008 and 2009, that were statistically very similar to market moves that we saw in 1938, which would not be available to us if we only relied on data going back to 1985. So it's very important to look at both, we think.
I have a number of different questions that are not necessarily related, but and I wasn't going to start with this, but it's kind of a segue. Do I understand that this strategy is based solely on the probabilities on a market index basis?
That's correct. It's the number one sort of analytical observation that we try and make is the likelihood of an index move over a given time frame. It doesn't matter if it's up or down, but every increment.
All right, and so it's really a mathematical exercise.
It is highly mathematical.
And it's based on the S&P 500 index. Do you do it for other indices, or is that it?
No, we look at all the indexes on which we trade options. So again, the Russell 2000 and the NASDAQ 100 as well. But the analytical engine we use is the same. We just need to add in different data inputs.
Are there different levels of data for each of those indices that affect the likelihood of success or failure in any way?
No, the sample set is big enough such that it's not meaningfully different. The Russell indexes go back to 1979, whereas the S&P 500 goes back to roughly the 1950s. And the Dow, we look at the Dow Jones as a proxy for the S&P for the 1940s and 30s, because those are very important to look at. But the statistical output is not statistically significantly different. Either way, you have plenty of data to work with.
Okay. And so there's no individual stock picking or market sector evaluation?
None.
Okay. So that's my first group of questions. All right. Second group of questions is really more for Liza, and Anders. Does our staff know the math and how it works?
I think we have a pretty good understanding of the strategy. I don't think we have to know the math because we're not doing the trading. They have to know what that is. I think our understanding and due diligence of the strategy as a whole has been very comprehensive. And I would say I think we have a fairly good idea of how this strategy works because we understand what call options are, what put options are, what a long position is, what a short position is, where's the profit zone, all of those types of things.
That you kind of jumped ahead to my last question, so I'm going to skip over a couple, and this was Bill Hayner's issue, I think, which is it okay for this board to approve this strategy without understanding exactly what the risk is, even though we've heard about historical data and what other people think, without really understanding the math and frankly, being a scientist like these guys are, we're not going to really know that we know what risk we're taking. But is that okay?
I think that's why you have a general consultant and why you have staff, and especially the general consultant. Their role is to do the rigorous due diligence, and they have done that. They come to us, they're not coming to us with a strategy that, well, we've looked at it and we think it looks okay. They've done hours and hours of due diligence research on this firm and the strategy. And when they come to us and they say this is a high conviction strategy for them and they're recommending it to their clients, I think we accept that they've done the work. I also think in this situation, staff's gone above and beyond some of the regular due diligence that we would do, say, for a regular equity manager, because it is a more complicated strategy. So we've had numerous meetings to really understand what it is that they're doing. We had a session with Jeff where he got down into the weeds of this strategy and went through it with us. We've had numerous calls. We've talked to other plan sponsors. So I feel like the due diligence has been there, and that you have to rely on staff as well as the general consultant and the manager to do what they say they're going to do.
Val, if I could also add, I mean, you have traditional, you have equity managers where they have models, statistical models and mathematical models, and they're putting in inputs and outputs that we don't know as well, that you don't know, that staff doesn't know. So it's not that different in that way. Yeah.
If I may add, to the extent that it's helpful, Aon knows. I mean, that we speak weekly. I was literally on the phone with our research analyst there, Kevin Rad, 5 minutes before walking into this room. They have 11 clients with us with about $3.2 billion under management. We've been buy rated since 2011. Their due diligence on us began in 2007. So you have a consultant who knows us as well as anyone.
I appreciate that. Those are great answers. That answers the second category of my questions. The third one was, if this is as predictable and reliable and as good of an idea as it sounds like it is, why isn't everyone doing it instead of investing in stocks? And is it growing? And as it grows, is that going to affect its performance? So that's my group.
Yeah, well, there's a number of really important points you raise here. So first off, I believe that the use of the option instrument itself has given some people pause where they have not adopted as early or as readily as they may have liked. Many of our existing clients began that way, and they have come to love the strategy. They have, almost without fail, all of our clients have either increased the asset level of their strategy over time or increased the alpha target of their strategy over time, across the board.
But what that probably tells me is they love the returns.
Oh, well, what's interesting is we don't actually, we learn a lot about what our clients feel about our actual investment process once we go through an investment or market dislocation. That's really important to us. Last August, we learned a lot. We had a lot of new clients. A lot of clients had come on board in the last few years, but they hadn't really been through a live drill with us. When August came, we certainly underperformed in August, and then we outperformed in September, October, November, and at the end of 4 months, we delivered the experience that we told them we would, and everything went the way we said it would. It doesn't mean we're always going to make money. We will tell you. Sometimes we will be in a difficult situation, and we'll tell you what the workout will be. And invariably, we're very good. I mean, we can't always make money for you, but we can usually give you a very good sense of what the workout period will look like. And it does go that way. And they really appreciate that. So what we have found is, while we don't like to lose a dime for any of our clients, only once we've lost them some money in a given month do they then really grasp how the strategy is. They can hear it, but until they live it, it's different. And so we have found that our clients don't just love the returns; they also appreciate the repetition and the predictability of the behavior, even in negative periods. That's really important to us. It's in everyone's best interest, ours included, to have investors who understand how things ought to go from a strategy behavior perspective.
Is there a risk that if everyone starts realizing that and increases their allocations and you get enough new clients, that's going to affect the effectiveness of the strategy?
Yeah, it's actually a really topical question because we're nearing a close on the product. By the end of the year, certainly, we will be closed, probably November 1, where we have estimated an amount where we can trade without creating any market impact on the worst day in the markets. For instance, last August 24th of 2015 would be an example of a difficult day. How many contracts can we move on a day like that without creating any market impact? and our estimate is almost upon us. We still have some room left, but we will cap it. What's important to us is that since there is no management fee, and because of that, this is not an asset gathering exercise. We have to generate the alpha if any of us are going to be accomplishing what you want and what we want. So there is zero incentive for us to go beyond the level of assets that we can capably accomplish the alpha objective on top of.
What if JP Morgan and UBS and everybody else jumps into this? I assume they're in this game, or they soon will be if it's...
Actually, not really. There's high barriers to entry. It took us 10 years of R&D before we launched the strategy, and it's not scalable.
And when I first came across a strategy and met with the PM, I said, so why aren't more people doing this, right? That's the natural question. Why aren't more people doing this? His answer was because options traders are not very good investment managers, okay? Options traders, where do a lot of them sit? They sit in the big investment banks on the prop desks making money for the investment banks. They take big position, big risk. They're okay with big downside because they're gonna make it up over time on big upside. That's not what clients want. They want that consistent, stable, managing risk controlled, managing downside that comes with the way they manage this strategy, so.
So I guess what you're saying is it's not going to grow that fast.
Well, so the higher alpha target, anything that targets 5% outperformance or higher, is going to be capped soon. There is a lower alpha target version, a 250, 2.5% over the S&P or some other beta. That has plenty of room. That has $9 billion available in capacity. But yeah, this is not a category killer. Nobody's saying, hey, I wish I could invest 10 years of R&D so that we can grow this to $7 billion. It's just not.
All right, so my last, that answers my questions. I have one more, which is, would you explain again how the fee makeup works when you have negative results over, what's the time period that you look at it, and how does that work to make sure that we're not paying to get back the money we lost?
Great. So the mechanism is a high water mark calculated on a quarterly basis. So at the end of every quarter, we've either outperformed the S&P or we haven't. We've underperformed. And if we've underperformed, that amount goes into a recovery, what's called a recovery account. That is a balance that needs to be earned down back to zero before new outperformance we can charge a fee on that.
For the life of the investment?
Correct. Now, the longest, we've only ever had a 2-quarter period where we were, quote unquote, underwater. And that was after 2008. But yeah, for as long as it takes. There is no sunset provision. It doesn't end. We will never, ever charge you a fee on outperformance unless it is new outperformance over what you already had. And this is calculated by our independent fund administrator, JP Morgan.
So we have basically a base year, when we come in.
Correct.
It's always there.
Correct. And the base will be the asset value times the return of the S&P.
So the only way we sort of overpay would be if it takes us a very long time to gain any return.
Right. If we did very well for you and then had a number of quarters thereafter where we were negative, you would have paid us a fee for those early quarters, and yet you'd be underwater. That is correct. But you have a credit for free alpha for life until we get you back.
As long as we stay as an investor.
Exactly. Now, right. But and that's an important point too, because we talk about a 4-month investment horizon for evaluating whether we're making you money or not. But it is still an equity strategy, and so we want our investors to come in with an appropriately long-term investment horizon as an equity investor would.
Thank you very much. That's really good explanation.
Thank you.
Appreciate it.
Carol?
Hi. So I supported this yesterday, and I'm going to support it today. You guys are all asking great questions. I feel like there's maybe more understanding here than we give ourselves credit for. I wanted to just go back to 30,000 feet on the issue of we're living in a low return world. We've reduced our discount rate several times. The capital market assumptions from the consultant really don't even support the discount rate we have now. So we have this gap, and we're always concerned about having to increase cost to the plan sponsor or members. So we need to look for alpha in the portfolio, and we've had the consultant and staff working on this for quite a while and spending a lot of time on it. And this is what they've come up with. The other parts of the portfolio the primary parts where we're going to get excess returns are private market strategies, which we can tolerate now, private equity, infrastructure, real estate. In the long term, we're not going to be able to tolerate so much private market. So to me, this is an interesting way to add alpha in the listed market. And I'm personally impressed with the level of review that's gone on by A.N. Hewitt and the staff, and think this will be a successful addition to our portfolio.
Can we buy an option to invest more in the future?
It's a topical question too. To the extent that investors come in and then we close, there is always the other fund, which is S&P plus 2.5. And the S&P plus 2.5 is, we launched that back in 2005. We think that is a very appealing product for a number of investors as well. So that will always be there.
Tanasi?
I want to echo a little bit about what Carol said, and that is, we are really fortunate to have great staff here. I mean, I'm not sure about Anders. He's so tall. I think the lack of air up there does affect processing. But there's no empirical evidence on that. But in all seriousness, we do have really good staff, and you guys are here. You guys are looking at this every day. I can't possibly know everything there is to know in the investment side. It's just not possible. And the reality is, just like all of our professionals, just like our actuaries and our auditors and everybody else, we have to take some of this on faith that the people that we hire are doing the right thing. I guess to Val's point in terms of what you know and don't know, listen, I got married without knowing a thing about women, and it's worked out pretty well for me. So I think this is not too far of a stretch for that. So I'll be supporting it.
It always goes back to the wife, doesn't it?
It does. Thank God she's not watching ever. I haven't told her we're on TV at all.
All right. Thanks. Bill, I see you're back in there again.
Yeah, so I kind of got this feeling yesterday that there's no downside and only upside. But there are some cases where you might have losses. Could you just explain those again, how that would happen?
Yes, I'd be pleased to. So like any investment strategy, there is risk. There can't be return without risk. We happen to think this is a more efficient risk to take. Our information ratio over the last 5 years has been north of 2, which is about 4 times greater than the return per unit of risk you get from a passive S&P portfolio. So we think it's efficient use of risk, but of course there is risk. An example would be in one of our profit zones, if the S&P 500 goes down below 12%, we have to move some of those option strike levels lower. We have to roll down, we call it. That can cost some money. And maybe we make money on our directionals, but maybe it's not enough. Maybe we don't fully offset the cost with the gains from the other positions. Certainly that can happen. It did happen last August. So that is the nature of a loss. What's also the case is that option positions can reprice even when we're not outside the dark blue. So I'll give you an example. We're good down to minus 12 on this page, but let's say the market goes down 6%. Well, options are going to go up in price. Market's down 6, people get afraid. The VIX index, which is the measure of option prices, goes up. So that is what we call negative mark to market. We're still on track to make all the money we set out to make, but the position has been repriced and we're short the position. So it's gone up in price. We show a paper loss, an unrealized loss. That happens. Option prices fluctuate even more than equity prices. So that can happen. So there's 2 very different kinds of loss, the real and what I call the fake, or I guess the unrealized. Typically, when we have realized loss, we might also have unrealized loss. For instance, in August of last year, we underperformed the S&P 500 by about 3.8% in August alone. But really only 1.5% of that was realized loss. We underperformed the S&P by 1.5. That's what we spent to control risk on our legacy positions. But you have the extra 230 basis points of loss that will come back to you. You just have to allow the positions to expire, which could take up to another 6 weeks. So, and that's exactly how it played out. So you had 2 types of loss. The loss can look bigger than it actually is, which is why we ask for a 4-month time horizon. And at the end of a year, we're right where we ought to be. But during the path, you're going to get monthly NAV statements that have negative numbers on them, and that absolutely can happen. What's interesting is in January, we underperformed the S&P by a little bit. The number escapes me. I think it was less than 1%. It was probably less than 50 basis points even. All of that was realized. There actually was no mark-to-market impact, which is rare, but it happened. But what we will do is, and you won't have to call us, we'll call you. We'll be calling Liza and saying, hey, here is the situation. Here is the breakdown of realized versus unrealized. Here's our expected workout if the existing market levels hold. And we'll map it out for people. And when we map it out, it tends to be quite accurate.
Is there any chance that you could get priced out of the hedging market? That if things got tough, the price of hedging would go to the point where you wouldn't want to put
Absolutely.
that cost up?
Not that we wouldn't do it, but that it would cost more. Absolutely, that could happen. It's unlikely that it would have a negative impact on us because at the same time the hedging gets more expensive, it also means that short option positions become more lucrative. So it tends to move in lockstep. But I guess there could be an extreme environment where the index levels at which we're selling don't go up in price, and the index levels where we're buying do go up in price. In that case, it could detract from returns, but that would be very unlikely, and the impact would be pretty small.
All right. So far, between committee and today, we've put about 4 hours into this item. I don't say that to cut the conversation off, but just to give a little bit of awareness. And I see Mark is in there with some comments, and Karina as well. So Karina.
Just back on this beta issue. So we're told that we get the beta for free, and the beta is presumably the S&P 5. But if historically you're investing 55% in the S&P 5, 30% in the Russell 2, and 15% in the NASDAQ 100, isn't that the beta?
Actually, that's different. The alpha and the beta are think of them as two separate sub-portfolios. So the beta consists of the S&P 500 exposure, which we typically would achieve. The lowest cost way to do it right now is through an ETF, 9 basis points it costs. And that is 100% of the invested capital goes into that. From there, we then build an option portfolio. The option portfolio can consist of options on other indexes. There's no relationship between the indexes on which we trade the options and the index in which the beta is invested. We do the same option positions on top of global equity. We do it on top of fixed income. So the option positions are almost for other clients. I mean, so think of the options as a sort of a separate sub-portfolio. And what we need to build that option portfolio is margin. We only need about 20% margin of what is available to us. So it's pretty capital efficient in that regard. But 100% of the invested assets are invested in the return of the S&P 500 via that ETF, or some other. We could use futures. We could use ordinary stocks. We could use a basket of ordinary stocks, or we could use a swap. Whatever is the cheapest way to replicate it, we will always do, the most efficient way to replicate it, but that will be where 100% of the portfolio assets are invested.
And then the ISDAs, can you talk about who you're trading with?
Yes. So we actually don't require ISDAs for this strategy because every single option contract we trade goes through an exchange, is cleared through an exchange. So we have no OTC positions. And certainly for the beta replication using an ETF, we don't need an ISDA either. But we do use prime brokers. Our prime brokers are Goldman Sachs, Societe Generale, and Barclays. And that is where the assets are custodied. And then we trade with those brokers as well as additional brokers, whatever's most efficient through our trading desk. And the only real risk you need from an operational perspective, the only real risk would be if your prime broker went bankrupt. and I say this because we actually we managed this strategy through a period where that was a real risk in 2008. Goldman Sachs was our prime broker. We've since added new prime brokers. But you can imagine if in 2008 an investment strategy had Goldman Sachs, Bear Stearns, and Lehman Brothers, and so we've really diversified internationally as well, which is really important to us. And we have a counterparty risk monitoring policy at Allianz where not us, but our two of our independent risk oversight groups monitor every counterparty that the firm does business with. So that is certainly well looked after, and that's how we do it.
Glad we're not using ISDAs, because then you'd have to explain what that means.
ISDA, I think it stands for 8-month delay in onboarding a new account. So it's good that we don't have to use those.
Is that November 1 date your idea of a high-pressure sales close? I'm just curious.
I'm sorry?
The November 1 date, I just wanted to know.
Oh, yeah. Honestly, it is a very bittersweet thing. I've personally been working on this strategy, trying to get people comfortable with something that is maybe a little unconventional for 11 years, and now we're going to close. We're just getting going. But we have to respect the integrity of the capacity process.
Mark?
Wanted to say that our board understands the fiduciary duty of you is to be engaging at a policy level, and that staff typically has been delegated the authority to conduct and oversee the operational due diligence of all of our investment decisions. And that works pretty well. I appreciate Thanasi's comments today, and kudos to staff for the due diligence we've already done. But I also want to give kudos to the board here. I think in my 9 years, I've never seen the number of questions raised by the board. You've just completed another whole operational round of due diligence on this investment prospect. Amanda and Jeff have done a great job of answering questions, so I appreciate your questions very much. They're all very good. You've just participated in some great due diligence, which I prefer normally to have staff handle, but I very much appreciate your input today.
Thank you, Mark.
That was the nicest way I've ever been told to be quiet.
Yeah, I'm in the same boat. Okay, so I see Karina back in there.
Just one other quick question. The 200 million, was that a minimum investment requirement?
No.
What's the minimum?
1 million.
1 million?
Yes.
From a sales perspective, I would have gone with like 150 million. I would have gone with that. Just a general. Yeah, that's what I would have gone with.
Yeah, no, I'm under oath.
Okay, so there's nobody left in the queue. So Bill, as the committee chair, you can make the motion without the need for a second, and we can vote on it.
I'll make
And
the
then we
motion
can-
to approve staff and consultants' recommendation to retain Allianz Global Investors for an alpha enhancing strategy.
Now, do we have to ask Allianz to leave the room for the vote?
Yes.
Okay.
Yes.
So we'll take a moment
Thank you
here.
very much.
Wait. How do we get the bribes?
Okay, Bill, move on. There we go.
So, before I make the motion, I think I am going to vote against this for a lot of the reasons that I brought up yesterday. I appreciate staff's due diligence and the work they've done on it. I just think it's a little far afield for what we should be doing right now. So I will go ahead and make the motion to approve staff's and consultants' recommendation to retain Allianz Global Investors for an alpha enhancing strategy.
All right, so you need to push the
button.
button there, make motion button. There we go.
There's a protest period. Give them time.
Ready to vote. All votes are in.
And the motion passed 8-1.
The motion passed 8-1.
right. Thank you, Bill.
So Karina's vote didn't get.
I didn't have the buttons to push here. It didn't come up.
Oh. All right, we can register your vote verbally.
No.
For the record, no? Okay, so Karina's a no vote, so 8-2. The motion passed 8-2. All right, thank you, Karina. Okay, with that, do we need to bring Allianz back in, or are we just moving on to the next item? Okay, all right, next item up. We're going to go to business operations for Chiron Study of Plant Experience, July 1, 2010 to June 30, 2015. So coming up, Gene, and we'll move from one easy one to another easy one.
You've had your allotment of questions.
All right, we're going to take looks like we're going to take a quick break.
That's
Tiny,
fine.
tiny blue, let's do it.
This could be a while. All right.
You already got stuff loaded up?
So now I activate this one. Put her in. There should be. So we're changing. So we're changing this one. Should I change it now?
Sure.
items today. One is to re-review and approve the experience study and the associated set of actuarial recommendations. So that'll be one item that we do, and then the second item will be consideration of any funding alternatives associated with those recommendations. So, Gene and David?
And then we have a public speaker that I'm going to plug in after your presentation. So,
Okay.
it's all you, Gene.
All right, I'm on slide 2, okay. As Mark said, we'll discuss, go back over the experience study. David's going to handle that, then I'll come back in and talk about the cost implications and some funding alternatives that might be available, and then I'm sure we'll have a short discussion.
Relatively.
Pardon?
Relative to other discussions, I assume.
Yes.
All right, so to recap what happened at the July 8 meeting, with the economic assumptions, you've already adopted back in November of last year, or September of last year, a reduction in the discount rate from 7.25 down to 7 1/8 in the 15 valuation, and then with the 16 valuation, drop that additional 1/8% to 7%, and your inflation assumption down from the current 3.175 to 3.05 for the 16 valuation. And for cost of living increases, it's linked to price inflation, but there's a cap of 2%, and we're assuming right now that it's going to be 2% per year. You've actually had liability gains for a number of years because the COLAs have been less than the cap for a number of your members. So we recommend dropping that slightly to 1.9%. On the demographic assumptions, we don't recommend any changes to the merit salary increases. Those are promotions and so forth. The experience was very in line with what was expected. For retirement, the experience was mixed. You had some groups with more retirements than expected. You had some groups with fewer retirements than expected. For termination rates, City had fewer terminations than expected, and the Port had more than expected. And for the airport, the experience was very close to expected. So for both of those assumptions, we recommend minor refinements to move you more towards the actual experience. For disability, there's been an ongoing trend of fewer disabilities than you've expected. We found that, I think, with the last 2 studies as well. So we recommend you continue to take those rates down. And then there are other miscellaneous assumptions you have, reciprocity, family composition, and so forth. And we recommend, again, minor refinements to those assumptions. But the one I just want to spend a couple of slides on is mortality, because that's what's driving the increases in the liabilities and the costs that we're seeing from this experience study. And this is just it's a graph from the Society of Actuaries showing how drastically mortality has improved. It's showing you the distribution of deaths, and you can see over time how it's shifted over to the right, and it's tightened up, so most people are actually dying now in old age. And recent studies from the Society of Actuaries and from CalPERS have continued to show that mortality is improving, and that's not slowing down. And there's been pressure from the Actuarial Standards Board and from the Society of Actuaries to move towards generational mortality, where mortality is assumed to improve every year instead of always remaining the same over time. So with that as a context, looking at your experience over the last 5 years, active members, there were significantly fewer deaths than were expected based on the current tables, which are from the Society of Actuaries published about 15 years ago. They're called RP 2000, are the tables that you're currently using. There are variations of RP 2000, but basically using those tables. And for healthy retirees, again, significantly fewer deaths than expected for males, somewhat fewer than expected for females. The experience for general and safety is very similar, so we don't recommend different tables for those groups. And also for disabled retirees, there were fewer deaths than expected for both general and safety members. So the recommendation after looking at the 2 tables, the RP 2014 table from the Society of Actuaries and looking at the CalPERS table that was developed, I think in January 2014, they issued their table. We recommend that you use the CalPERS mortality table, which is based on actual public sector experience. And we recommend that you project that 20 years from the 2009 base year that table was established on, using a variation of scale MP 2015, which is a mortality improvement scale from the Society of Actuaries. So it's effectively a 13-year projection from the 2016 valuation year. And we call that, it's a static projection, meaning it's not truly generational mortality in that you're not assuming every year mortality is improving, but it's trying to approximate generational mortality.
And you might want to add the reason we didn't go the generational route. We didn't want to have to come back each year and change substantially equal contribution rates for the members.
Right. So now looking at the cost implications, this is a slide we had at the last presentation. It summarizes all the different assumptions, the recommendations, and what the cost impact would be. So some of these items are increasing costs, some are decreasing. But again, the key driver of the numbers on this slide, slide 8, is mortality. In fact, with the city, everything else more or less balanced out, and the $35 million that we see on this slide that's the impact of mortality alone. So what we show here on slide 8 is just, these are estimates based on the 2015 valuation. We won't actually know the impact of the new assumptions until the June 30, 16 valuation is completed. And one thing I want to point out is the numbers in this table are just based on the new demographic assumptions. They don't reflect the reductions in the discount rate and the wage inflation that you already approved last year. So you can see for each of the 3 plan sponsors, the estimated liability impact is in the range of 4 to 5%. And the cost impact for the city is $35 million, and for the port and the airport, it's between $1 and $1.5 million. On the member contributions, just from the new demographic assumptions, the estimated average increase, of course, the rates are based on entry age, but on average, the estimated increase is 0.6 to 0.7% of pay for general and 0.6 to 0.8 for safety members. When we take everything together, including the reductions in the discount rate and the wage inflation rate, which haven't yet been baked into their member contribution rates, into the rates that went into effect on July 1st, 2016, when we look at all those new assumptions together, it's about 0.8% of pay for general members and 0.8 to 1% of pay for safety. So if you had a member who was making $50,000 a year and their rate went up by 1% of pay, that's $500 a year or $40-something per month. For UPD and APA, anyone who's not subject to PEPRA, because we don't have substantially equal, there would be no change in the member contribution rates. For PEPRA members of the port and the airport, the rates would be adjusted if needed to ensure a 50-50 split. If there's a provision that if the normal cost rate goes up or down by more than 1% from when the rates were initially established, then you have to recalculate the rates so that they're now on a 50-50 basis. So if that threshold is exceeded, which we don't think would happen, but we haven't gone through the full exercise, then those rates would not need to be adjusted. So at this point, I'll turn it back to Gene to talk about the funding alternatives.
Before you go there, Gina, I had a quick question for you, and I hope I can get this characterized right. So we did an experience study of our plan experience, and we looked at our mortality, and we see it's improving. But the question I have is, there's a component of their generational improvement, meaning our each generation, the mortality is improving more and more. With that said, our youngest generation of employees are not members of the system because we have a closed system. So was there an adjustment at all in our liability or our costs to account for the fact that our youngest generation of employees, at least on the city side, our youngest generation of employees are not in the plan and therefore increasing a liability because of their improvement over the years?
We made a 20-year adjustment, as David had mentioned, so it's not a generational improvement. So we didn't actually apply a generational improvement to this plan. Okay. So we're probably assuming the current generation is living longer than they likely will, and that'll.
I like that assumption.
Okay. Okay. But it's it's approximation for the whole group, all the different generations, and it's. Again, done because if we'd had true generational improvement each year, we had to come back each year for substantially equal contribution rates.
Okay. All right. Thank you.
So, funding alternatives. Why is that even being discussed? These assumption changes came at a time that we had low investment returns as David mentioned, a significant increase in mortality. And you saw this on slide 8, the substantial increase in cost, but that's not really what's driving it. What you'll be seeing soon and later, in fact, if I can just slip ahead to slide 12 just for a second, but I'll come back to 10. The bottom graph is showing the projected city contributions, and you see an enormous drop of over $150 million in, what is that, 2028 or 2029?
29.
And there, I'll start walking through, but that's part of the driver. And when you've got a drop in contributions like that, that has implications on the investment side. It increases negative cash flows. And so that is also a driver in considering some of the funding alternatives that we'll present here. The alternatives that we have before you are just maintain the status quo. The board has a policy for 30-year amortization of assumption changes. But we could also consider some fresh starting of some of the unfunded liability bases. We could adjust some of the unfunded liability bases in order to spread the impact of that cliff that you saw. And we'll show you the impact of each of those. Or we can do what a lot of plans, especially in California, have been doing. They're just phasing in the impact of the ADC due to mortality. They recognize this mortality change is sort of a sea change, as a one-time event, and it's worthwhile phasing that in because it affects several generations down the road. So back to slide 12. Slide 12 shows on the top graph a projection of the system's liabilities, and you can see by the year around 2028, those gray bars start declining. That's the impact of the closed plan is taking over. And the lines are the assets, and at the very, very top of the chart are the funded ratios, where you start at 76% and end at 100. Again, this is based on the June 30th, 2015 val. And on the bottom, we're looking at the member contributions. And on the far left, there's a table. The first column shows the returns. That's what the assumption is. We're going down to 7%. And I highlight in dark blue font the next fiscal year from which these assumption changes will impact the numbers. And you see, before recognizing the fiscal year ending return of 1.1%, the ADC would have been $267.9 million for the city. And if you flip to slide 13, if we factor in the 1.1% return, that 267 goes to 276. We still have a cliff at the bottom graph. And then when we factor in the assumption changes, we're up to the 311.3. So that's the first option, which is maintain 30-year amortization and live with that. And actually, I think rather than I'm going to do the UPD and airport separately and not like go back and forth. So I'm going to flip to slide 22. So you saw the 311. If the board just maintains the status quo, the 5-year phase in which many plans are doing with the mortality results in that ADC going to 283.5. Another option on slide 23 was to say that we could go and take any base that's less than 15 years and fresh start it to 15 years. With the exception, I believe, of the 2007 base. We're leaving that alone. But then we also thought of, I'm going to go back to slide.
Go to the model now?
Yeah, go to the model. That'd be best. Can you get rid of the bottom? Usually there's a box that's prompting you to do something. Or maybe you can put it to the side. Well, I think I could work my way through it without doing that. Okay, so there's a third option that's not in your deck that we thought of. You see at the bottom chart where you see the gold bars and that big cliff there? What we were thinking of doing is looking at the a couple of bases that expire at that point in time, and to say, well, 20% of it will expire that year, 20% the year after that, 20% the year after that, and then the next 2 years. So we'll stair step our way down to the low rates. And David, if you could plug that in there. You see the stair step down?
Yeah.
If the board were to consider going to a different alternative rather than maintain the status quo, that's probably the approach that we would prefer over the other alternatives here for the city. And if you
And
could
this
flip.
is strictly for the city plan.
Yeah, we're going to go to the UPD and airport. And I want to bounce back and forth.
What would you actually call this approach? Because the other ones all had labels.
Step
amortization-
down.
Step down, okay.
And this is the 291.5
Yes.
that we're looking at.
But what I did is I took, Mark asked for a graph of all the alternatives, including the status quo, and how they compare as far as the city's contributions, that's in the top chart, and how they impact the funded status. So on the top chart, that gold bar is if you do nothing. You see the leap up to the 311, and then the dramatic drop down in 2028, and then everything after that's about the same. And then the red is the 15-year minimum, but it's still has a step-down cliff in 2033. The 5-year phase-in, which is, I think, a lime green, while it provides some relief in the early years, it still has the problem of the cliff. And the approach that I said we prefer, which is the step-down approach, is that light blue. It doesn't give as much relief, but it does step down and avoids the massive cliff in 2028. Yeah. But the most important thing, and I've read the article in today's paper and talking about kicking things down the road and items like that, but if you look at the bottom chart, the impact on the funded status of whichever approach you take is practically insignificant. All the funded status are in a very tight range of each other.
Isn't this just a question of which group of taxpayers pays which portion of the bill?
No, it's more than that. Having steady, stable contributions is healthier, even from an investment perspective, than having spikes. I've always felt that in any pension plan, the stakeholders are multiple. It's the members, the plan sponsors, the taxpayers, and everyone has an interest in this. And to the extent you can keep things predictable and level, that benefits everybody in the long run.
But from the member's perspective, it's the lower graph, the funded ratio, and it stays level regardless of which manner in which you choose to fund the obligation. But the difference I see in the upper graph is that taxpayers who are paying taxes in the year 2030, for example, are going to have, the city basically is going to have a larger chunk of its budget going to fund its pension obligation in the year 2030, and that's a trade-off for having a smaller portion of its budget going to fund that liability in the year 2020.
Yes.
So it's a transfer. I think the object or the point of those articles you're talking about may have been that there is a transfer of the obligation forward.
Except that the current taxpayers, we're talking about, Alan was talking about older generations. Inherent in the liabilities, the retired life liabilities, are older generations of taxpayers. So do you spread the cost of these mortality increases in general, well, the mortality improvements on one set of taxpayers, or do you spread it out a little bit more amongst more taxpayers?
I wouldn't necessarily take. I might think it's better to spread it out over more taxpayers and over more time. But I guess what I'm inviting you to do is make that case, because I don't see it as having, based on the lower graph, I don't see it as having a major impact on the funded ratio for the members.
My entire career, I've always advocated try to maintain a contribution level that is steady and predictable and not have spikes. Because whenever I've seen spikes in either direction, bad things happen. You saw the closure of the plan. So I always work to try to, when we've had spikes coming down in costs, that's when we've come to you and talked about tightening the discount rate and not letting it drop down. This is now one of those reverse cases where we have a spike up.
So smoothing for smoothing's sake has some value.
Yes.
So the 291 kind of smooths that cliff out, is
Yes.
what you're saying?
Yes.
Yeah.
Without having any measurable impact on the funded status of the plan.
Now, there's really three different layers of smoothing that we do. Is that right? There's a 5-year, a 15-year, and a 30-year? And it
Well, the
depends
15
on-
and the
there's a-
30 are applied to different things. The 15 is
That's
applied
what I'm
to
saying, different
investments.
things. So the discount rate is one type of smoothing, is that right?
Yes.
And then the mortality assumption is another level of smoothing, and then the market changes are another level of smoothing. So in effect, one's 5 years, one 15 years, and one 30 years. Is it my understanding that we have about 17 layers right now of smoothing that we're doing from the past?
Yeah,
That
probably.
sounds about right.
Yeah.
15 or 20 different layers of the
Yes.
UAL.
UAL.
So we've done a lot of smoothing over the past, which has helped, what you're saying, try and keep the spikes from occurring.
Yeah, but you see that one big drop, what's really causing that is back when the city closed the plan,
Right.
we compressed everything into everything non-police into one level dollar. So that's why the big, and there's a 2008 or
Investment
9
loss.
market loss. So there's two big factors causing that huge spike down. So we're taking only those two UAL bases and splitting them into 5 pieces so you can step your way down.
So the 291 to 311, so that's about a $20 million difference there that the city would be paying in next year if we went to 291 instead of the 311.
Yes.
But it does help down the road. Not right now. It doesn't, it helps the city out now by reducing their payment by 20 million, but it smooths out that cliff, way out in 2030.
Yes. And this may not be the last time we come to you and talk about that cliff, because that cliff can start changing shapes with future investment returns.
Can you go over one more time, Gene, all the reasons why you believe the cliff is something we should try to avoid?
I'm not sure I put that strongly. Why it'd be better to deal with the cliff in a gradual way?
Yes.
Well, from an investment point of view, you're going to now, from one year to the next, have an increase in cash needs of over $160 million. So there's a negative cash flow all in 1 year.
That's going to affect your investment decisions and what
Well,
you...
it's got investment implications on liquidity. The other thing I mentioned was that I found that systems that maintain contributions that are more or less stable and predictable, less bad things happen to them. So we always work to try to keep things as stable as possible. In fact, all the funding method we use here is called entry age, and the purpose of the method is to have a level percent of pay for an employee's entire career.
But the only thing you pointed out that's specific is a political risk when you say bad things happen.
Closure of the plan, participants lose benefits, accruals. Generations of workers aren't going to earn benefit in this plan. I would think those are your members here, or they would have been your members.
Yeah.
But we're talking here about political risk, not financial or...
The cash flow is a financial one.
That's the financial one.
Yes. And then going to these methods, the bottom graph there is showing you the difference of the methods is indistinguishable almost on the funded status of the plan.
So before we're moving more into discussion off a presentation at this point. Do you have much more in the presentation?
Well,
I want to make sure we get through the presentation. Then I have.
I think we should now just briefly look at the UPD and the airport because they're a little bit different.
Okay.
So,
because I have a public speaker, then I'd like to hear from Chris a little bit on fiduciary duty before we get into more discussion. Too much more discussion.
Okay, so the UPD also has a cliff. It's not as pronounced as the cities. This is before making the 1.1% return for the year. So you go to the next chart. That increases everything. Then you go to the next chart, which is the assumption change. Is that in there? I didn't see
Right,
it.
that's for the new assumptions.
Oh, I didn't see the difference between the one. Go back to the baseline. Okay, then the 1% and now the assumption change. So their spike is from, I can't read.
15.4 to 15.9 with a new return, and then 17.3.
But 14.6 was last year. But Mark has had conversations with the officials at the UPD that you might want to share.
Following last board meeting, you all asked if I would reach out to the 3 plan sponsors and discuss this in a little bit more detail, and I have. And as you might expect, all 3 plan sponsors quite accurately understand that it's our board's plenary authority to decide how to set actuarial assumptions and how to do the funding of the system. So I don't know that any one of those 3 plan sponsors wants to attempt to tell us what we should be doing here. So that's the case for all of them. With the city, and we may get into this more with later the discussion, going from 261 million this year to 311 million next year is a $50 million increase. I believe that would have implications on the city. If you were to look at the airport and the port increases that are reflected in these charts, they are similar percentage increases in terms of what their ADC would be. But in absolute terms, the dollar amounts involved are, of course, much smaller. So it's my understanding from the contact I've had with the port and the airport that the dollar amounts involved are not as significant relative to their operational budgets as they might be to the city. So that doesn't mean that they don't like to have predictability and not spikiness in their contributions as well, but the absolute amount of the increase is not as traumatic, my word, not theirs, in terms of what they would like to see.
So if you go to the model for the UPD, if we apply the step down for the port, first, all right, so we have assumption. So instead of 17.3, what does the step down do? 16.5, and you see there's a little bit less of a cliff, so it's not as pronounced as the city. And then we go to the airport. First, do it without any relief. They don't have a cliff. They're well funded, nearly fully funded. In fact, that's part of their policy, so there is no cliff for them. And in fact, we can't really find ways to give them relief because you have a policy that says never have negative amortization.
That's the airport policy.
That's their policy,
Sorry.
yes.
Correct.
This board has the policy, negative amortization.
Sorry, yes, right.
Not the airport.
Yeah.
But they have a funding policy that says if they drop to a certain level, they put more money into the system.
What is it, 90%? Or
I think it's
Yes.
a goal to be at 95%, and if it dips below, they need to take steps. And if it dips below 90, they need to
So that
immediately
policy
get
is going to
back.
overcome anything you decide here today. So I don't think the airport authority will impact your thinking on this because I don't believe the board is prepared to change the negative amortization policy, and the airport has its own policy. So the port gets a little bit of relief, so it all really comes down to the city. And so that's maybe a good stopping point where if you want to let Chris or another speaker come in.
Okay, so we have a public speaker, April Bowling, was here. Here she comes. And then after Ms. Bowling, we'll go to Chris for a little review of fiduciary duty real quick.
Thank you, Chair. Is this on? Yes. Okay. Chairman and board members. My name is April Bowling, and I chaired the Pension Reform Committee back in 2004, and wanted to take just a couple of minutes to kind of go back through the history of some of the outcome, the issues that we found at that time, the outcome and the changes that we've had. One of the things that we determined back when we had the Pension Reform Committee and reported it out to the city is that there were actions that were being taken and some uninformed, some informed but well-intentioned, some informed and perhaps not so well-intentioned. But the problem was that we were facing in those years was that the financial impact of those decisions was not being fully acknowledged when it came to the pension liability. And meaning that there were decisions being made that deferred the impact of a decision, whether it was an assumption change, whether it was a benefit increase, regardless of what that was. And as a result of the Pension Reform Committee's work, there were a couple of changes that were made. One had to do with the composition of this board, because the Pension Reform Committee felt, and the voters agreed, that it was very important to make sure that a majority of the people who sat on the board were independent, did not have two masters, and understood that their responsibility was to the plan, to the participants, whether they're active or retirees, and that that was the most important important obligation that they had, and that we needed to make sure that the plan was moving toward full funding at any time. Obviously, it's not going to get there immediately, but that it was going to get there ultimately. The second measure that was voted on by the people had to do with the amortization period of 15 years. And I think there's a lot of misunderstanding about what the reason for 15 years was. Yes, it did eliminate negative amortization, and that was a byproduct that was an excellent thing to have happen. But the notion was kind of the accounting concept of matching. And that when you have an employee that is providing work for taxpayers and for the city, that at that time, that the full cost of that employee should be acknowledged, budgeted for, paid for, et cetera. And the full cost includes the full cost of that particular employee's pension. Understanding that they're going to work for X number of additional years and then they're going to live some number of years after that, but that the taxpayers and the employee themselves who are then employed should be the ones bearing that cost, not future taxpayers nor future employees, et cetera. And so what you're looking at today with a combination of the assumptions and potential changes for phase-in, you've got some challenges. And one, of course, is the mortality. Whenever we're talking about assumption changes having to do with investments, there is smoothing and things that are worked into the system. But your assumption change having to do with mortality is one that's difficult. And in looking at your last meeting, there was discussion about, is this an anomaly or is this a trend? And so I'm not here today to say you should do this, you should do that. What I am saying is that the reason for those two ballot measures and the reason for the 15-year amortization is the concept of matching and making sure that we really are matching up the cost of an employee now with the benefit now that's being received, so that future taxpayers aren't paying not only for the employees that they're getting benefit for, but also paying for people who have been long gone. And so that's my comments. The Taxpayers Association is also very interested in this issue and has asked me. And I'm going to put on a different hat now and say that at the back, I could feel myself starting to flush about how proud I am of the Airport Authority, that we are indeed nearly fully funded in our plan, and good for us. Thank you.
Thank you, Ms. Bowling. So I'd like to go to Chris Waddell, our fiduciary counsel, now as we move through this decision and kind of have a little review of our duty as a board. And specifically, to me, it falls into two different duties, and you can help clarify this, Chris, for me. One, we have a duty to minimize contributions and not necessarily overcharge our members or our plan sponsors. But two, we also have to maintain the health of the system so we can provide benefits to our members and our participants. So with that setup, Chris, I'd give it over to you to talk more about.
Thank you. I'm going to slice and dice the duty questions slightly differently than you just did, Alan. Basically, as we've talked about more than once in fiduciary training and when the board first discussed this issue a couple of months ago, there's really two core fiduciary duties that are set forth in the California Constitution. The first is the duty of care, and the second is the duty of loyalty. And the duty of care, as we've talked about, is really a question of, has a prudent process been followed? And part of a prudent process is having advice from your expert. Part of the prudent process is having questions and answers between the board and your expert staff so that you're completely comfortable that you know what you need to know in order to prudently cast a decision. A close cousin of the duty of care under the Constitution is the duty to provide for actuarial services, which again, you obviously have Gene here. He's provided you his advice. So duty of care in this instance seems fairly straightforward. I think the question, and you really touched on that when you mentioned the duty to minimize employer contributions, is the duty of loyalty. And what I'd like to do, it's not that long, trust me, is read the provision from the California Constitution and then make a few comments about that. So the provision from the California Constitution reads as follows. The members of the retirement board of a public pension and retirement system shall discharge their duties with respect to the system solely in the interest of and for the exclusive purposes of providing benefits to participants and their beneficiaries, minimizing employer contributions thereto, and defraying reasonable expenses of administering the system. A retirement board's duty to its participants and their beneficiaries shall take precedence over any other duty. So, in this instance, you have a situation where the Constitution expressly references minimizing employer contributions. I'm not sure that you can look at that phrase and say, well, we're not really minimizing them here, we're spreading them out. But leaving that aside, the question becomes, how does that duty fit with the primary duty of what's in the best interest of the members and the beneficiaries of the system? And Gene has, I think, given you an important data point with respect to that, which is separate and apart from whatever the city may be interested in this instance. Gene has expressed that mitigating the cliff is actually in the best interest of the system with respect to the cash flow issue and everything else. So the bottom line is that if you're comfortable with both the process that's been followed and the advice that's received from your actuary and what's with the best interests of the system as a whole, it really becomes a judgment call. There's no right or wrong answer with respect to any of the alternatives that Gene has outlined from a fiduciary perspective.
All right. Perfect. Thank you, Chris. So with that, I have people in the queue. Okay, everybody's lined up. I love
surprise.
it. Yes. All right, Ed, you're up.
Okay, I have several comments. One, Ms. Bowling really struck a chord with me, being a former CPA, about the matching concept. That's something that holds true in accounting, and I've never used that term in this situation, but I think it actually holds true. We have to match today's expenses with today's contributions as best as we can. I think, as some of you on the board know, I still think our discount rate is too high. I think 7% is too high, and that's something we're going to have to deal with down the road, but I think we have to keep it in the back of our minds today. I actually have a different funding alternative, and it deals specifically with the $35 million. And that is, we know, at least I believe this is factual, the city has already put aside $15 million in a fund for future pension issues. Well, the future is now. My proposal is to bill the city for the $15 million today. That leaves $20 million to go for the $35 million, and to do that over a 5-year period, which is $4 million a year over the next 5 years, which certainly is not peanuts, but it's not a huge impact on the city budget. And at least in my mind, I think that's a very fair and equitable way to pay for this $35 million one-time shot. I don't like kicking things down the road. We are kicking it down the road a little bit, but I think that's something that we have to do. And again, I believe anyhow that does it with a minimal impact to the city.
Ed, can I just point out, the $35 million is not a one-time shot. It's every year in the future.
I thought this was kind of a catch-up on the $35 million.
No, the slide 8 says that the impact of all this is $380 million, and 35 is the payment towards that.
Over how many years again was that? That was
30.
30 years.
Well, it folds in some other things too, but primarily, as David said, is mortality.
$400 million on payments for 30 years is about $1 billion, so it's $30 million for 30 years.
Right.
Yep.
Okay, well, that negates part of what I was thinking. But I would still be a proponent of funding as much into the system today as we can, because the earnings on that will start today and not tomorrow. If the more we put in today, the more we earn on it. And I think if the $15 million, in fact, is there today, the city has set that aside. I think, as I said, the future is now, and I think we should bill the city for that and get that into our fund as soon as possible.
Al?
I, too, am concerned about matching and what I'm going to call generational fairness. but I don't know whether I am entitled to consider that. So the first thing I'd like to do is ask our fiduciary counsel to tell us what role generational fairness or any kind of fairness to taxpayers plays, if any at all, in our consideration.
There's a Attorney General opinion directly on point on that. And the subject matter was CalPERS asking the Attorney General whether or not it could spread out the impact of a benefits increase beyond the lifespan of the members that first received the benefits increase. And they specifically raised the question of generational matching, or however you want to characterize that. And the Attorney General said that the board's fiduciary duty to do what's in the best interest in the members of the members and beneficiaries of the system trumped the issue of generational equity, which doesn't mean that you as a board can't consider that issue, but it has to be in the overall context, not with respect to what's in the best interest of taxpayers, but what's in the best interests of the members and beneficiaries of the system. And that kind of goes back to Gene's comments about, the hazards of the cliff, if you will.
Thank you. And yeah, go ahead, Gene.
On this concept of matching, keep in mind that if you're matching an active employee or member's cost with the current taxpayers, that's one thing. But when you've got generations behind that active person, from older generations, should that be put on just the current taxpayers?
I agree. And my analogy to that was to say that haven't many, if not most, of the people who enjoyed the steak dinner already left the restaurant? And if that's the case, and we're now sitting here with the bill, that somewhat mitigates or weakens the argument about generational fairness, in my mind, though it doesn't eliminate it entirely as an important consideration.
I would agree.
Thank you.
We just looked at, I think it's over 60% of liabilities have left the restaurant.
All right.
All right, Natasha.
I've taken a lot of notes, and I actually went back and watched 2 board meetings because I have no life. And so I watched the September 2014 one, and I watched the January 2015 one. And the reason I went back to that is I wanted to hear our discussion again on the admin costs and how we want to address that. And at the time, it was $12 million of an impact. It was catching us up.
Yes.
So, the people in years past didn't pay for that. We were catching up to that. But we spent a lot of time talking about the impact to the sponsor. And, I think we ended up, everybody had different ideas of phase in time periods, but we did phase it in. And the plan sponsor impact was a consideration in that. I've taken notes from Chris's comments in the past as well. And our goal is to have enough money in the system while we minimize the plan sponsor impact. And according to Gene, any of those options don't really affect the funding. I think I look at the impact to the members, our retirees, in services, in resources to our active members. We have about 40% retirees living in the city of San Diego who will be impacted by any reduction in services or resources. So I just wanted to share what my thoughts were. I also read some economist reports. So
You really need to get out more.
I really need to get out more. But, one of the things that was interesting is for private plans, because they're addressing this as well, that they're talking about Congress taking action to potentially enact legislation to smooth out the effect so that they minimize the impact. So I have a lot of little comments. I have more pages, which I will not bore you all with, but those were really the highlights of what I wanted to share as far as our thoughts went.
Thank you, Natasha. I'm up next, so I'm going to join you in the nerdy world of pension study. One of my favorite charts that you show, Gene, is that stochastic chart. Can you bring that back up for the city with the step-down option?
What's a sarcastic chart?
Well, actually, this is
Yes, a stochastic chart. That's what Gene calls it. I don't even know what that word means. I just heard him say it a couple of times.
Is it, what do you call it? Is a deck or?
Yeah, is the, yeah. As I've sat here over the years,
Step down.
and we look at all of these different charts and graphs and everything, and a point that Gene has made time and time again, that our actuarial valuations and our analysis, although it's a snapshot in a moment in time, what we're really trying to do is see where we're going, where we're headed as a pension plan, and where we are headed as a health of a plan for our members. And so one of the things I tend to look at in these charts is in the upper half there where you have the actuarial liability bars, the vertical bars, and then you have the green and yellow line, which is the value of assets in the both market and actuarial. And that really kind of shows our future of where we're headed. And our goal is what you see at the far right of the chart there, or as that you see in the beginning of the chart, where those come together. And a matter of when and how those come together is really what we're talking about here. I'm very sensitive to any decisions that will cause that gap to get wider over time, because I think that's what we saw with MP1 and MP2, and with a retroactive benefit increase without an actuarial analysis. Those were the decisions of the past that caused those things to diverge. What we're talking about today is not causing those two lines to diverge. We're talking about how do we bring them together moving forward, but still provide for the health of the system, which is bringing those two lines together, but minimize contributions both for the members and the plan sponsors. So when I look at the step-down cliff or step-down option that Gene proposes here, I see we're getting there. I see that in the early years, that gap between the lines and the top of the bars is closing. And then as we reach our maximum liability because we're a closed plan, the line continues. That gap gets smaller and smaller and smaller over time. And so that's why when I look at this option here, I think it embraces both our duty as Chris articulated out of the California Constitution, and in both fronts. It minimizes employer contributions, and it maintains the health over the long haul. I appreciate Ed's idea, and I appreciate the creativity of all of these things. And it's really a tough balance. The idea of generational fairness, I get that. I hear about it all the time at work. As much as we want to be fair between generations, it's really what we're trying to do here is achieve health of the plan over the long term. And so those are the points I'd just like to make. Thank you. Tanasi?
I think a couple of comments. I think the debate that we're having is how quick to close the gap between the green line and the top of the gray bars. And there's a couple of facts that are out there. We inherited a system that is below funding. The fact of the matter, had certain decisions not been made when they were made, we would look closer to the airport plan, closer to the port plan. And I think we can all agree that those two plans are in a better position to guarantee the benefits to their members because of their current status. As an example, I love Ed's idea, and the reason I like the idea is because I think it's kind of, I think the technical term of art is poopy that the city is going to put aside $15 million, invest it and sit on that, and the investment returns, and the plan isn't going to have the benefit of it. If you really think it belongs in the plan, it should be there. The fact of the matter is we don't need to bill them for $15 million. We just simply take the $311 million contribution rather than the $291 million. We get to the same place. I am concerned that it's going to take us 25 years to get to a point where this plan is in a position where I would say as a fiduciary that we can guarantee benefits to our members, because I don't think we can say that today. There's a lot of time, and that funding gap is wide enough. Not our fault, but it's wide enough that it is. I don't think we can sit here today and say, yes, look our retirees in the face and say, we can guarantee your payments. By the same token, I think it would be disastrous to turn around and say to the city, hey, get us up to 100% funding. Let's crank up the URL, get the city to write a huge check, go to the members and ask them to take an enormous pay cut to put in their fair share. It's a problem. And because we can't go back and wave a magic wand, at the past, then we have to do what's reasonable. I liked our guest speaker's comment that there's a goal of trying to match generational cost. Realistically, that's impossible. The fact of the matter is we are withholding on an assumption today, and we don't know whether that assumption was right or wrong until tomorrow. Whenever that tomorrow is, whenever Gene gets around to doing his work, we find out whether that work, how close we were to that cost. So all of these things that we're doing, it's nice to know the goal. I think the goal is an important goal. I think that's what we want to do. And I think we as a board have been trying to do that. But I want to be careful that we don't assume that we can actually get to the exact dollar amount per employee for their generational cost at any given point in time. We can't, okay? And I think Gene's recommendations, I think the smoothing becomes critical. My concern becomes, what happens if we hit that cliff? The city gets back $100 million in their contribution, and then all of a sudden we have a 2008 or 2009, we have a problem somewhere, and we need to go back to the city the following year and say, whoops, that cliff isn't still there. We need more money. Well, here's what I can promise you. As soon as we don't get that payment from the city in one given year, the following year it's going to be spent somewhere else, okay? And the pain of getting that back is going to be problematic. We are the gatekeepers of keeping the city and the members honest for funding this liability. And if we take our foot off the gas pedal, we're going to create problems across the board. And at the end of the day, no member is going to come back and say, you know what, I didn't put in my fair share. They're going to blame the board. They're going to say the board made bad choices. I hear it today every day. The board made bad choices. The city council made bad choices. All those people who aren't in office, who aren't here anymore, they made bad choices. I don't want to be one of those people. And only history will judge me. And so from my perspective, I'm going to come out on the more conservative side, because if history's going to judge me, I want them to say that bastard was really, really too conservative, but nobody lost any money. Nobody was denied benefits. Okay? I don't want to be the guy that says, man, his poor judgment resulted in the fact that the retirees have to take 5% less, 10% less. They have to delay their retirement for 5 years or 10 years or whatever the case is. Having said that, I think what I do this to you all the time, Gene, and I do this out of a tremendous amount of love for you, and also I enjoy watching you squirm. I think the important part here is I'm looking to you, and this is my same point that I had in our prior discussion with Allian and whatnot. I'm not an actuary. I'm not an investment advisor. I'm not even sure I'm a very good husband or father. But the point that I'm making is that I need to rely on my experts to give me the very best advice. And what I've always appreciated about you, Gene, is you do look at it globally. You do look at the whole picture, and you really are concerned with the health of the system. And the health of the system, when you listen to Chris and you talk about the two duties of loyalty and care, at the end of the day, if we blaze the path that is in the best interest of the system as a whole, then we are going to be doing the very best we can, given what we inherited, given what we are today. So I don't view this as I want to make sure that the city doesn't have to pay too much, or the members don't have to pay too much. I honestly can't consider that. I need to know what is in the best interest of the system. And when you give me charts, and I can see there's a in one sense, you say, hey, that green and that yellow line, boy, I'd like to have more money up front. I'd like to have the earning power of that. Hey, that red line doesn't look so good. That blue line kind of looks like a middle path. And maybe the middle path is the right way. What I really want to know from Eugene, and I know it makes you squirm a little bit, but what is if I am solely concerned with what is in the very best interest of this plan, and therefore, secondarily, I'm going to do the very best for my members and my plan sponsor, what's the path that I need to take as a fiduciary sitting up here? What is the recommendation that I can rely on, sleep well at night, and hope that I'm going to be judged fairly and appropriately in history?
You're asking me what is my recommendation?
Your recommendation.
Well, let me back up.
But I charge by the word, so I couldn't ask it that succinctly. It'd just be unfortunate.
We had a Taxpayer Association official speak today. I recall at prior meetings we had one of the union speakers, and in a way, the work we're doing gets criticized by both. I feel like we're doing a good job when that happens. So I don't know how many times I've come here where the contributions were going to go down, and that's when I came to you and said, let's tighten up this assumption, let's lower the discount rate. So I've come to you many times to do the opposite. This time I'm offering an alternative which says, well, now we have a spike up. If you flip to the guide, we're we're not recommending, we're saying you've got reason to consider it because as Chris Waddell, well, I said it actually, the cash flow issue, there is no impact on the funded status. So it's not, you don't have to worry about not sleeping at night because those lines at the bottom aren't going to determine whether someone's going to get a pension or not. They're practically the same.
They're pretty close.
Yeah.
But when you look at the health of the system, then the question becomes globally, when you look at the health of the system, which path to get, I mean, basically what you're saying is whatever path we take, we're going to get the same result. So fine, take the result out of it, because I think that's where we're at. What path makes the most sense for the health of the system and balancing all the parties?
I'm going to, there's one system that I've actually been an actuary for the entire 30-year amortization period. That's the state of Maine. When I took over, the state of Maine was 22% funded with a 10% discount rate. Today, they're 81% funded with a 7% discount rate. And they've made a steady trek all the way from 20 to over 80. Their contribution rate never went above 20% of pay, never went below 15% of pay. Every time there was a spike down in contributions, I lowered the discount rate. Every time there was a spike up, we came up with ways to smooth that out. The goal was to keep contributions as level as possible, and I think that is the soundest thing for a system, and not to have to face the spikes. I don't think this system would have had perhaps the pressure to close the plan to members if there was that kind of a philosophy.
Exactly. So is that the blue line? I mean,
That is the blue line, yes.
That's the blue line. Okay. Well then, and thank you for that, because that's the advice that's meaningful to me. That's the advice I can hang my hat on and say, you know, hey, that's going to be that smoothing is there, the benefits are there. So I appreciate that. Thank you.
Bill, you're up next.
So I think there are a couple considerations here that have me concerned. One is that we are a closed-end fund, so we're not getting new members in. What we have is what we have, and the membership contributions coming in is what we have. I'm more in favor of what Ms. Bowling said about pay as you go, and let's take the hit and do the 311. The concern I've got is that we have a $2.4 billion unfunded liability with this, with the latest decisions we've made, getting close to that. And since I've been on the board, it's not gone down, it continues on up. And my concern is that with it being a closed-end fund, we really need to get that gap closed as soon as possible and do it in a orderly way, which I think the 311 would do. I kind of view the idea of, in the financial world, I think smoothing's a fairly good idea, but in our case now, we've got these 17 layers of smoothing. We smooth everything, and I think there comes a point where you've got nobody can predict the future. So I can't predict what the market's going to do between now and 2029. And we've lowered the discount rate because we believe the market isn't going to perform as it has in the past. I believe that we are in a slow growth economy, worldwide, global economy, and that's going to continue for a number of years. So my feeling is we need to make those payments and make sure that in a closed-end sense, our members are going to get paid out in the end and not defer it out and keep deferring it out.
Thanks, Bill. Natasha?
So I just, wanted to comment too, and I meant to do this earlier when we talked about the reserve fund. It's my understanding that that's also for the low investments returns, so which is about 10 million this year. So it's not just these spikes; it's these spikes as well as the investment losses. So it's it considers both. And I guess I look at when we talk about the health of the plan, to me, that really correlates to the health of the organization. The city is going to be there. The city is going to pay. So I'm not as concerned about that, particularly if we're getting to the same outcome. Why not minimize the pain to the plan sponsor, to the current taxpayer, to the members, and to the retirees, if you are going to get to the same place?
Thanks, Natasha. I'm back in there. And again, because I had a couple more points I wanted to make after more discussion. This may come as a surprise to many, but I have a bias on our plan sponsors. And my favorite plan sponsor is not the city, actually. It's the airport. And I say that because as we go through these processes, we make these decisions as a board for the health of the system. And we basically lay a foundation of what needs to be done to provide these benefits to our members. And we've done that. We've done that well over the past 10 plus years. And the city's made all of its payments. But what the airport has done, on top of the foundation that we have laid, if they have come in as their own policy and said, you know what, thank you, board, but we're going to do this too. We're going to add this into the system. And we're going to make an extra payment, if you will, for our portion of the plan. There's no reason why the city can't do the same. If we lay the foundation, and the foundation is solid, and the foundation is going to provide for health of the plan, there's no reason at all why the city can't take that $15 million and say, you know what, apply that to us. Or they can't establish their own policy at the council level as, you know what, we're going to set these numbers. And they have things. We have corridor provisions and those types of things. But they can do more. Our job is to make sure there's a foundation that's going to make us healthy. One of the reasons I like Gene's idea here is it really comes to for me kind of an equity issue. When we do member overpayments, and we go to the members and we say, hey, you know what, there's been a mistake made. You owe us money. We don't go to that member and say, you know what, we want all that money today. We don't do that to our members. We go to the members and say, you know what, you owe us money, but you know what, you can make payments. We can spread this out over time. We can make this less painful on you as a member. Well, effectively what we've done here is we've identified, in our experience, a correction that we need to make on a mortality. Had we done that years ago, yeah, this probably wouldn't be such a big deal, but it's not how we do business here. So we've identified a correction that we need to make, and there's a cost associated with it. So why wouldn't we give our plan sponsors the same fairness that we give our members and say, listen, plan sponsor, this is going to be $400 million of liability spread out over so many years. This is the cost. We're going to lay a foundation to make sure this bill gets paid. And I don't think there's any disagreement on this board that this bill is going to get paid. It's just a matter of how we pay it. Lay that healthy foundation and then go to the city and say, if you want to pay more, you can pay more. If you want to pay it off sooner, you can pay it off sooner. Just like we say to our members whenever we have to correct their benefit. So those are the 2 points I wanted to make, and then I'll move on and Val, you're up.
Thanks, Alan. Earlier, when talking to Gene, I was identifying what I viewed as the two risks of the financial cliff, one, or of spikes or major drops, one of which is a political risk. I've tried to think about what's the political risk to the members and to the system of having this big drop in the year 2028, 2029. And frankly, I can't, maybe it's a failure of imagination, but I'm not imagining that as the risk period. That's a time when there's going to be a lot of cheering in the streets. The political risk I see is now from the increase. And I'm not sure that's a huge political risk to our system or its members so much as it is to any board members who vote against the smoothing. In the sense that they may be persona non grata at City Hall for having done so. And I'm not sure that's a political risk I care much about. I don't think I can and fulfill my fiduciary duties. In terms of the impact on investment strategies and returns, I see that cash flow problem as a very real risk that I'm somewhat more concerned about, but we haven't heard from our investment professional staff on that. And so I think that's a big missing piece. So I'd like to interrupt my last comment to ask if the investment staff would like to comment on it.
Yes, I would actually. Thank you. That yellow line, that big cliff, is very concerning to me because on a pure cash flow basis right now, every year we're in the hole to the tune of about $80 million. When you put that on top of that, that's a huge impact on cash flow. That means that not that we can't deal with that, we can, but that's going to take some significant planning to accommodate for that lack of cash flow. So something that's smoother like the blue line makes that easier to handle.
Does it potentially reduce our returns portfolio-wide if we're having to prepare for that financial change?
Not potentially, no. I mean, we'd have to adjust everything probably pro rata. Something that we are going to be doing on an ongoing basis from here on out. Every year, the consultant, Dan Hewitt, is going to be doing a liquidity analysis of the portfolio, because as we get closer to the time when the cash flow starts tapering off, we may have to make changes to our asset allocation, specifically with regards to our investments in private markets.
So then, Liza, what I'm hearing is that there's a significant cost and burden on staff, but not necessarily a major risk of lowered returns to the members. Is that fair?
Yes.
All right, so that brings me to my last comment, and then I know Gene, and I also know that our fiduciary counsel would like to respond to some of my misstatements earlier. So with that, do I understand, Gene, that in the comparison of options chart that's presently up, the blue line would get the green line to the top of the gray bars in the stochastic chart on page 12 in the year 2046?
Yes.
And not earlier?
Well,
based on all of the projections and our best information.
You're not going to earn in 7% each and every year.
I understand that's a factor, holding that equal for all of my questions.
Yes.
Okay. So then, under the yellow line, the green line reaches the top of the gray bar. In other words, we're fully funded if everything goes as planned, which most assuredly it will not, in the year 2028.
No. Go to the model, David.
That's the prior chart. All right.
The bottom
So
graph.
let's get the year.
Setup shows that.
There we go.
Show the difference between the step down versus not having a step down. And
So it doesn't get you. So either step down or non-step down. We don't get the green line to the top of the gray bar until 2046 under either scenario.
Correct.
All right. So there's no difference in terms of the risk profile. We don't get fully funded earlier, whichever way we go.
Correct. But there was one other thing that Tanasi brought up that I hadn't thought of. That I think you brought this up, but it's what how.
It's a good idea. Yes, I did.
If the city experiences the big cliff in that 1 year and everybody's joyous, like he said, and that money's spent elsewhere, the very next year, if you have a horrible return and it's got to come back spiking up, it's going to be that much more difficult to get that money.
I can't fix politicians.
Right. But politicians can fix this plan.
Yes.
I think this is still on. I am by no means predicting the future here, but I think that there are lessons from the past on this issue of risk. I'm less concerned about one element of the risk, which is, the purely political. But I can tell you that there have been other situations in the past where there has been a big drop-off on a one-time basis in employer contributions into a plan, and it can be very hard to get the money back if it's needed later on. And it may not be ultimately at times, again, I'm not saying anything about this system or this city, but that situation has led to litigation in the past. So I don't think that concern, can be dismissed. It's a potential, because that flat bar, I think Gene has said pretty clearly, those flat lines in the out years are a projection, and your actual mileage may vary, and there may be spikes in the future, and that could create the issue that we're talking about.
Sorry, I was staring at the chart. Ed.
Actually, Chris just answered my question, so I'll withdraw.
All right, thanks. Tanasi, you're back in.
Thank you. What I want to point out, Val, just briefly, is that all of the models are going to have us fully funded in 2046. The question becomes, how close is that green bar to the top of that gray bar between now and then? And the faster you get here, theoretically, the better off you are. Let me give you an example. If we had never had the problems we had in the past, and we had to deal with this mortality shift, we wouldn't have the consternation that we have today, or it wouldn't be as acute today, because we had more reserves, more funds, more whatever the case may be.
Actually, Tanasi, the reverse would be true. if you were fully funded and the city was only contributing 100 million, that mortality thing would still cost the 380. So it would be a bigger spike.
And I apologize, but let me just make sure I understand this. But the difference being that if I'm fully funded, that effect would take me from 100 to 80% rather than from 80 to 70% funded, right? I mean, I'm still closer, much closer to my issue. So the battle we're fighting is the closer we are to fully funded, the better we are going to be to deal with market risks or these other risks that come about, because the impact is going to be less. So I don't think it's an issue if we're going to try and fund it earlier, but the question becomes how much padding can I put into the system so that if I have a 2009, if people start to live 20 more years longer than they do currently, I am in a better position to weather that storm or to make it a little more palatable.
So does it matter as between the yellow and the blue lines in regard to that?
Well, I mean, I think it does. I mean, from a straight perspective, if we go back there, the green line is the most. I'm sorry, the yellow line is the most aggressive funding. So theoretically, dollars in our plan are going to be working for us longer and are going to be better off for the plan overall. So in one theory, you'd say, well, we should have the yellow plan. We get more money in, have it longer. It's working. It's doing all those things. Liza and her team are going to do this great job with it, and that's all well and good. But the smoothing is still taking. So fine, we get this big bump, but when you put this into this actual model, we're still going to curve that out to full funding in 2046. So the question becomes: I certainly have more protection if the problematic event happens in the next couple of years. Right. The problem is we don't know when the traumatic event's going to happen. If you believe Bill, we're going to be on this very, very slow upward track. That may very well be true. And there isn't going to be a big drop or a big spike or whatever the case is. So from my perspective and why it was important to me is, from a gut perspective, I want the city to put in as much as they can right now. I want the members to put in as much as they can right now. By the same token, I don't want to shock the system. If I create a problem with my plan sponsor that they can't fund the plan, it doesn't matter how accurate Gene's numbers are. If we get to a point where the city puts themselves into a hole because politicians are politicians, okay, and now we get to a point where they say, well, gee, I know you're supposed to fund at 300, we can give you 150 because we don't have it. I mean, I don't want to have that discussion in front of a bankruptcy judge. So the question becomes, how do I guarantee that the system is going to be there? And that's what went back to my question to Gene, which is, hey, what path is the best path overall for the integrity of the plan? Okay, and that's what I want to make sure we get to. The other issue is I hear fairness a lot. Is fairness to the plan sponsor, fairness to the plan participants. Guys, that's a dangerous, dangerous word. We are not in the business of fairness. We are not here to dispense equity and justice. We are here to make sure that the plan pays its benefits. That's our job. It doesn't matter if it's unfair to the city or unfair to the member or unfair to... We didn't create fairness. The politicians, the unions, all those guys could have cast a different light on fairness during the negotiations, during whatever it was that they did. We get the inputs as they come. Our job is to make sound business decisions to make sure that we guarantee the survival of the plan. And that means making sure the city is in the best position to keep making its payments, the members are in the best position to keep making their payments, and we want to make sure that we lower that gap between the green line and the top of those gray bars reasonably and as fast as possible. We would all get there immediately today if we could. We can't. Not our fault. The question is, what are we going to do between now and then? What's the best path? And that's why I've appreciated Gene's comment on the blue path. And when we ever get to a vote on this before 5 o'clock, I'm voting for the blue line.
Thank you, Tanasi. Natasha?
I just wanted to make a comment because there's talk about savings when the cliff happens. But I don't know if everyone recalls when Prop H passed. It earmarked all those savings to capital improvements. So that money is already spoken for. And as Gene said, if there is a dramatic situation, that money, that savings is not available at that point. So I just wanted to throw that out there.
Thanks, Natasha. Bill?
I think I go back to the unfunded liability that has been building over the years and now is taking a fairly large jump. And if you look at the funded versus unfunded percentage, it kind of, if you go below 70%, you get into a range where it's very hard to ever come back. And this, where we're moving to is from 75 to 73 or 2, I'm not sure, something along those lines. It's moving in the wrong direction. And I think that the sooner our responsibility to be able, to the members out in the end, is we've got to get this thing down, because at some point there may never be enough money for the city to pay. And I don't see the returns coming in at 7%. I mean, yes, we lowered down to 7%. I think that's great. That's a move in the right direction. But I'm very concerned that if the returns, what do we have, 1.1% this year, 3.3 last year? If we ever had 3 years in a row of down, or 4 years in a row?
Hasn't happened since early 2000.
So it hasn't happened for a while, but we're potentially facing that situation. That'll make it even harder for the city if we don't bite the bullet now. So anyway, I like the 311.
Alan, I just wanted to jump in with one comment about the effect of lowering the discount rate. We've lowered the discount rate from 8 to 7 5 times over the last 9 years. Had we not done that, had we still been at 8%, the UAL currently at $2 billion would be cut in half.
Right.
Had we not done that, our funding ratio, which is currently at 75%, would be almost 85%. Order of magnitude, it's about 10 funding points and about half of the UAL. So that's how significantly we have tried to reduce risk by asking more contributions coming in. So the board's done a tremendous job of working that UAL down by forcing more contributions in, despite the fact that the UAL seems to be hovering around $2 billion.
And I think that's a great point, because to try to compare the current unfunded liability with the unfunded liability that was established in 2008 or 7, it's not comparative, because the methodology to calculate it has completely changed. The discount rate, everything is completely changed. If we're going to compare apples to apples,
Another way of looking at it is to say, if we took today's assumptions and put them back to 2008, that unfunded liability was quite a bit larger than people thought it was at the time.
Correct.
Yes.
Yes.
Absolutely.
Yes. Yes. All right, Jeff.
So this is just a horrible situation, and we're trying to find a compromise to, appease everyone. And it's not fair. I agree with Tanasi that there's going to be suffering somewhere. And I believe the blue line is the compromise that we can all live with going forward, and, like you said, sleep at night. And we made our best decision. And the payment structure for the plan sponsor looks like something that can be budgeted for, could be handled, and we can move on. And I'm in favor of the blue line, and I would ask if we should change the motion to say to approve the split cliff UAL in 5 layers.
So do I hear
plan.
a motion? Do I hear a motion to approve the Chiron study and adopt the step down?
Yes, step down, yes.
Alan, we'll get to the motions in a little
Okay.
while.
Okay.
After the discussion, we've got
Right.
2 action items. Yep.
Okay.
I do want to ask one question to
Okay.
that, if I could, Gene.
You can pull that motion down, please.
To Bill's question, going from 75% funded to 73% funded today by adopting that blue line path, what additional jeopardy is there to the system? I mean, it was your recommendation, so I'm assuming you've considered that, and despite the fact that on paper we're now going to be funded at 73 versus 75 or whatever the number is, that irrespective of that, that's still the best plan. But can you elaborate on that?
Whether it's 311 or 291, the bottom chart, looking at 2018, do you see much of a difference in the funded status? It's not going to be different.
Yeah.
And the 2.3 billion probably would exceed 3 billion if we applied today's assumptions back to the old stuff.
Right. Okay. Thank you.
So the growth in liability really came from tightening the discount rate, tightening all the assumptions and the mortality, as opposed to growth in liabilities.
Val?
Gene, it seems to me that before we even knew what the results of this experience study was likely to be, we were talking about ways to smooth that fiscal cliff.
At the board retreat, we spent
Yes.
a lot of time talking about, we didn't even know about the experience study, that this cliff is problematic, yes.
But at the time, as I understood it, we were anticipating that we would be able to work on ways to smooth it even without regard to this experience study. And my presumption is that the experience study and what we're facing now sort of calls the question of, do we do it this way? But there are other alternatives
Yes.
for smoothing that cliff. So a vote against the blue line and in favor of the yellow line doesn't necessarily predict that we are going to be unable to smooth that fiscal cliff as we go forward, does it?
You had double negatives in there, so.
I did. That's a lawyerly question. Let me try it more simply. There are other ways and other times that we can smooth the financial cliff, even if we were to vote today to go ahead and have the
Yellow line
as being our
Yes.
path.
Yes.
And to continue that analogy briefly, I said we have 2 action items coming up. The first action item is to approve the actuarial experience study and the associated set of recommendations. If the board does that, you're now at the yellow line. We have a second action item, which is, do you want to divert from the yellow line? So we'll get to that in a minute.
Thank you.
All right, there's nobody left in the queue. We ran out of gas. So with that, we'll go to the first action item. Is that how you envision this, Mark? To approve the experience study?
Yes.
Okay. So I have a motion by Bill Hayner, a second by Val Hoy.
Ready to vote?
Could I just ask, I need clarification.
Oh,
from
okay.
what you said. By doing this, are we now approving the yellow line?
We are approving all the actuarial assumptions at the current funding policy. So yes, we're
That's the
effectively
yellow line.
approving the yellow line.
But without prejudice to then voting on the blue line.
Correct.
That's
Next.
my question.
Someone would have to make the motion, but yes, we can vote
It's
on the
up.
blue line after.
After we've approved this,
But we're going to
we
approve
can
the
go
yellow
back.
line.
Well, because we
You have to as a
We have to approve the
precursor.
study. I mean, the fact
Yellow line
is
is the study.
And then we're going to, by my understanding, discuss a modification to the funding policy to bring in the impact of the study.
You could almost think that the motion is not so much the yellow line, but the liability is increasing by 380 million.
Yes.
Okay.
That's truly what we're doing.
Accepting the
That-
conclusion.
If the next motion fails, then yeah, we're on the yellow line.
Okay.
Yes.
Thank you.
Okay, so and that's all votes, it looks like. And the Chiron study on plan experience is approved, 10-0.
Denise Thompson is
Yep. Okay, so the next item will be a motion to adopt the funding of the step-down policy proposal for the liability increase related to the plan experience.
Alan,
Did I get all that right?
just so I understand, that is, and I'm not trying to put words in anybody's mouth, but that is, as I understand it, a recommendation from Eugene as to an appropriate step. And the reason I'm asking is I just want to make sure that when we set the motion up, it's either to approve your recommendation or we didn't consider you at all and we did it anyway, or we're not doing it. I just want to make sure we understand it.
We have no problem with either the yellow or the blue line.
Okay.
But if we had a preference, it would be the blue line.
Okay. So can the motion read to accept Gene's preference of the blue line?
Yes.
Do you want to ask David his preference?
Let's add David's preference in there as well.
It's like we're voting on a trolley line.
We should also clarify here whether this is a step down that we are voting on only for the city plan or the city and the port or the city, port, and airport.
Doesn't apply to the airport.
Doesn't
because they don't
apply to
have a
the
cliff.
airport. I agree with that.
And I would think the port, it would apply to the port, but the port has the option of putting in more money, as you suggest they may do anyways.
Right.
So therefore, we should clarify, Johnny, you're paying attention, the motion should indicate that this is for the city plan and the port plan.
Well, the port, it has, if we look at the model, it has very little impact.
But it still has a cliff that we can deal with, whereas.
But it,
For
doesn't
ease of
really have an
purpose,
impact.
what difference does it make if there's no if we have it for all 3 plans and there's no cliff, then it's irrelevant. Why do we even care? Why don't we just make it system wide? I mean, when you sit down to do it, if there's no cliff, then
Creates negative amortization, I think, for
will it?
the airport.
Yeah, I'm going to ask Kyron a comment. If you were to approve a step-down plan for the airport, does it trigger negative amortization, number one, or does it even make any difference?
I don't even know if, get the airport up there. You know, because we didn't even see a cliff, there's nothing to step down from.
It doesn't change anything
they're stepping
initially
up.
because they're already in a position where they're making a negative amortization payment.
Yeah,
So-
It doesn't make any difference.
so it wouldn't make any difference.
So we can approve it across the board.
Yeah, yes, you can.
Okay.
Okay.
So we can remove the language for city and port plans from the motion.
Yep.
Oh, I see Tanasi and Bill in the queue. Did I miss something?
No.
Oh, you're gone.
Sorry, I took myself out.
Okay, so I just would repeat again my position. I think we're kicking the can down the road by going to the blue line. I think the yellow line is the responsible way to go. It is a pay-as-you-go rather than pushing it off. So
And I concur with
I
Bill.
can't support the blue line.
Yeah. We're all going to have a moment here
We are.
to register our desires. Okay, so we have a motion to adopt the step-down funding approach for all three plans. And so I will make the motion. I need a second. So just as a matter of course, is there any more discussion before we vote? Okay.
Ready to vote. All votes are in.
And that motion fails 6-4. So as a matter of policy here, we need 7 votes to pass a motion. So even though we have a majority of the board in favor of the step-down approach, that fails because we need 7 board members to make that happen. So, okay. Thank you, Gene.
Thank you.
Thank you, board. Very healthy discussion. Yeah, let's take a break and then move on to item number 3. Okay, let's get started. I think we have everybody back. So going back to the top of the agenda, item number 6, Audit Committee. Ed?
Okay. So in the interest of fairness, do I get an hour and a half?
As much time as you need, no.
Okay. The Audit Committee met on Wednesday, September 6th. The first item of business we had was selecting a chair for the committee for that one meeting because of Denise Thompson's resignation. We took a quick vote, and Greg Kovieski was selected as chair for the meeting. A new permanent chair will be selected at our November Audit Committee meeting. And the approval of Greg as the chair for that meeting was 3 yes and 1 abstain, which was Greg. We then had a discussion and consideration of the internal auditor compensation. Luli, our Human Resources Director, presented a salary compensation survey of other comparable California public pension plans with an internal auditor, and SDCERS plan sponsors the city also having an internal auditor. Based on this analysis and the performance of the internal auditor, the committee recommends a salary increase of 3.5%, effective September 10th, 2016. This recommendation was approved by the Audit Committee, 3 yes and 1 abstain. And I believe that's we need a vote on that at the board.
We're going to come back to that at the end of the meeting.
We are?
Yep.
Okay.
We're having a technical delay with the screen here. We're working on it. Thank you.
Okay, so that's the issue.
No, it's coming
Yeah,
back.
it's not a process issue, it's a technical issue.
Gotcha. Then we had new business, no action. Ted went over the unaudited June 30th, 2016 financial statements. The statements are still subject to adjustment based upon any adjustments our outside auditors come up with. Plus, we still don't have valuations as of June 30th for some of our alternative investments. Once we have that, we can finalize the statements, and the auditors can finalize their audit. Aon Hewitt then gave a total fund performance report for the year ended June 30th, 2016. Liza Krisafi gave an overview of our total fund performance. She discussed that we had returns of 1.1% net of fees for last year, and again, that's subject to adjustment, and we're assuming it's going to be an upward adjustment, how much we don't know on the alternative investments. We then had a conversation of the internal audit staff size, and I should say that conversation, we actually, when we were talking about the compensation of the internal auditor, we tabled it for a few minutes. We brought Lee back in, and we talked about his plans for the internal audit staff size, whether we should increase the staff size by bringing on another person, whether we should do some outsourcing and co-sourcing for information technology audit services. We just wanted to get an idea of Lee's vision for the internal audit department before we vote on his compensation. We actually didn't come up with any discussion, with any conclusion, and we're going to come back Lee is going to come back in the November meeting, talk about what he does in the IT area. We're going to have MGO talk about the work that they do in the IT area, because our biggest concern as the Audit Committee is cybersecurity. And we're not sure at this point in time all the pieces fit together, so we'll hopefully come to a conclusion on that in November. Next, Dave Kramer, his term as on the Audit Committee expired with the September meeting, and we had an open seat on the Audit Committee, and the committee is recommending Julie Furl of Leaf & Cole to join the committee, and that will be an action item for when the B&G report comes out.
Preview, she was approved.
Excuse me?
Preview, the vote was to approve.
Yes, the vote was to approve. I think Julie is very well qualified. We then had status reports from internal audit. Lee spoke about the status of the current audit plan and his prior audit recommendations. We had an audit committee activity summary presented by Dave Kramer. We just went through all the activities of the audit committee for the past year. And we had a legal services compliance report from Johnny, which will be part of the B&G committee. We had board comments at the end of the meeting. The audit committee thanked Dave Kramer for his 6 years of service on the committee. And a request was made to have Dave Bond start attending the audit committee meetings and present the report, again, because of just our increased awareness and concern about cybersecurity. Not concerns that we're not doing anything right, but our concerns as a committee, we really don't know everything that's going on, and it would give us some more comfort. And that's my report.
You want to come back to the action item now or at the end of the full agenda?
End of the full agenda.
Okay. All right, business operations, we already take, is that it, Ed?
That's it.
That's it, okay. Operations done. Disability Committee, Natasha?
Okay. So we had a meeting yesterday, and there were 6 items. Johnny recused himself for one of the items. We had 3 approvals of non-industrial, 2 approvals of industrial, and 1 denial of industrial. And the 1 denial of industrial was what took the majority of the time. I think everyone is, even I'm familiar with the case of Scott Armstrong, and and actually it wasn't a denial, I'm sorry, we tabled it. We tabled it. We voted unanimously to table that and not do a denial. And the reason for that is if we did a denial, he would have no options to come back and get an industrial disability. If we table it, it's my understanding that he has as much time as he needs. Is that everyone's understanding? So that was a difficult one because I think in the Muni Code, it states that a mental or nervous disability does not qualify. And I think we all felt that if we could give it to him, we would have. So that was a tough one. There was also one that we wanted to compliment staff on, and that was the situation with Michelle White. And it's our understanding that Sandra and the team went above and beyond. She had visiting out-of-town family. This was the individual with the brain tumor, and they really accommodated the family and made a difference in that process. So just wanted to point that out. So don't know if there's any comments or questions?
No, just as a matter of process, maybe Johnny can help us out here. If we want to put all these on consent, because these were all unanimous from Disability Committee, we would need to change the language on item 1 from deny to table.
You could just put consent 2 through 6.
And then vote on 1.
And then don't do anything
Don't do
on
anything
1.
because committee tabled it. Okay.
Correct.
Okay.
All right.
So then we'll go ahead and make the motion to approve items 2 through 6.
Ms. Joyner, who normally does this, had a family emergency, and our backup also had a personal emergency. So I've given Melanie about 2 hours of training. And so I appreciate your patience and thank her for her help.
pressure.
here.
The person that trained her, she'd probably be fine.
Thank you, Thanos.
Okay, so the motion still says 1 through 6. It needs to change to 2.
Except items 1.
Except item 1.
Oh, except item 1. There it is. Okay. It's in and then it's out.
Okay, I'm going to go ahead and make the motion. There's no second.
Ready to vote.
There we go.
All votes are in.
Okay, that passes 10-0. Sandra gave a report. Things are going really well, and they continue to. It's a testimony to the staff. They're working hard and decreasing that time every time they come back to us. So good job. And I think
That's it.
that's everything.
All right. Thanks, Natasha. Business and governance. Val?
Thanks, Alan. Business and Governance met yesterday at 10 a.m. for about an hour and a half. The consent agenda consists of items A1 through 11, except for items A1, A6, and A9, which I'll pull for discussion separately. The other items all passed unanimously, and I would move their approval here. No seconds necessary.
No.
Ready to vote? All votes are in.
All right, and that carries 10 to nothing. That brings us to item A1, pulled from the consent agenda. This is the denial of Janet, the staff's motion, or staff's recommendation to deny the appeal by Janet Hewlett regarding the overpayment of her 13th check benefit. B&G voted 4-1 to table this matter and to ask staff to make a formal written request to the city to pay the accrued interest on the overpayment due to Ms. Hewlett's financial hardship. We don't necessarily anticipate that the city is going to agree to that, but we thought it appropriate to make the request and to do so formally before we took the matter up in committee. And so that item was tabled. So I would move approval of the decision to direct staff to make that request and to table the item until we have the response.
Do we need to move a tabling? Yeah.
Why don't we just, when it comes back on?
I guess it says move the item here in my notes, but I don't really need to move that.
Do we need to move it if it's?
If the board doesn't take any action on it, then we'll just do what you
Stays
listen
tabled.
to.
Right.
All right, then I'm going to withdraw the motion and leave it as a report and
How you doing
go to
over there,
item
Melanie?
A6. Item A6 concerns revising Board Rule 2.41 to reflect the board's decision to lower the crediting of interest to member accounts to 7.125%, effective July 1, 2016. B&G adopted the item 5-0 as amended to state the interest on member accounts for fiscal year 2016 at 7.25% and for fiscal year 2017 at 7.125%, and for fiscal year 2018 at 7%. Staff passed out copies of the revised board rule, which everyone should now have. And so I will move approval of that item. Should I move on? Maybe I should move on to reports, and we'll come back to this when we have our
We can.
system up and running. Or we can do a voice vote.
Why don't we
Raise
do
hands.
a voice vote if that's okay, Alan?
Sure.
given
Yeah, that's
it's not
fine.
working.
All right,
And
so
then I'll
I've made
that.
Record it.
I've made the motion, and at this point, I would ask for a show of hands of all those in favor. Any opposed? Motion carries unanimously. Let's go then to A9, which is just, this was an item that was taken off calendar because the member is no longer requesting a waiver of Board Rule 9.70. Then we move on to new business. Item B1, Mr. Tran gave the annual report on fees in excess of $50,000. No actions required. Item B2, Johnny also gave the semi-annual travel and training report for the period January 1, 2016 to June 30, 2016. No actions requested. And item B3, Marcel Rossman provided the annual report of resolved overpayments of benefits and underpayments of contributions. Then under old business, which is category C, item C1 concerns an update on overpayments to members exceeding $10,000. Marcel reported that 2 matters were resolved after the report was finalized, and 2 more were resolved through the appeal process before reaching the board. The board very much appreciates staff's hard work on resolving these matters without having to bring them to the board. That brings us to status reports by division. Legal and compliance, Johnny Tran highlighted the legal division's use of pension software generated letters related to community property matters and submission of SDCERS revised conflicts of interest code to the City Council. IT, David Bond reported that all iris defects reported under the warranty have been corrected by Sagitech. IT completed the annual business continuity plan update and will conduct a planned disaster recovery exercise, which is scheduled in October. And Dave reminded us to please update our iPads to the latest version of the Apple operating system. Under member services, Cynthia Queen reported that the call center team worked hard to improve call wait times, and the average wait time is now down to 27 seconds as of this month. Supervisor Shinquana Pemberton closely monitors service levels and continues to support the team in providing excellent customer service. Thank you, Cynthia. Under benefits administration, Marcel Rossman reported that SDCERS has participated in a benchmarking survey. In it, we calculated that 97.7% of retirees received their first benefit check within 30 days of their final paycheck from their plan sponsor. And complete results of that survey will be presented at an upcoming board meeting. And again, congratulations to staff on achieving that outstanding benchmark. I think there was some comment about how in the past retirees were informed that they should wait at least 60 days from the time of their last paycheck while they were working until they got their first pension benefit check. So that's a huge improvement. Under finance, Ted LaSalvia reported that current priorities include the fiscal year-end financial statement audit and the implementation of the financial reporting disclosure standard, which is GASB Statement Number 72, Fair Value Measurement and Application. Ted also went over the June 2016 trust financial statements. As of June 30, 2016, SDCERS has a net position of $6.7 billion and total investments of $6.7 billion. For the 12 months ended June 30, SDCERS had a decrease in planned net position of $136 million, reflecting net investment income of $5 million. Fiscal year, Ted also reported on the fiscal year 2016 actual expenditures versus budget. Administrative expenses totaled $44.2 million for the 12 months ended June 30, 2016, which was 9.4% under budget. The budget had been $48.7 million. Salaries, IT, litigation expenses, and investment management fees were all under budget. That concludes business and governance report. Thank you very much.
Thank you, Val. Bill, let's move on to investment committee.
Actually, I just had a comment on, I meant to say it before, on item 11 for the board election process. I just thought it'd be a good idea if we switch to elections being all on the SDCERS website wherever possible, just for ease and convenience and financial-wise. I know that's nothing we can decide right now, just something in the future. Just move towards that.
Cynthia, you want to weigh in there?
Just that was discussed in Jessica's update yesterday, that is what the next process will be. This one was done via paper only because the existing system had broken down at the last minute. So we have a new vendor, and it will be utilizing online voting at a very efficient cost, with also alternative formats for anyone who has special needs or desires. Thank you.
And that system gave us decades of service.
Bless
when
it.
that broke.
And it wasn't ours.
All right, investment committee. Bill?
So The investment committee met yesterday.
Actually,
We
Mr.
got
if-
through,
Hold on, Bill.
If I could interrupt just a bit, we are still having some technical difficulties. So we are in the process of trying to reboot our software, and I believe we have lost the ability to do video temporarily.
We have video, but if we reboot the system, we'll lose the video. So
So
we
should we
could do
take a
the whole
break?
meeting by hand.
Or should we-
Or we could take a recess for 10, 15 minutes and restart the system.
Or just don't say anything important during the reboot.
Let's take that 10-minute, grab those sandwiches, have a quick lunch, and then we'll come back and power through. How's that sound? All right, perfect.
Great, thank you.
Yeah, break or recess or whatever we.
We do have lunch in the back.
Yes.
I'm told we do.
You got your carrots, you're all set.
So,
You guys are asking questions.
yeah, and it's not.
Notre Dame guy wrote a
I'd like to button my jacket, but that's not possible.
Ready? Is everybody ready to continue on with investments, Bill?
Okay. So.
All right, let's get started. Let's call us back to order here, and we'll get going on investments. Bill?
So yesterday, we had our investment committee meeting. We had 10 items, and we got through 5. We covered 1 this morning, so we can check off item number 2, which was the Allianz decision. And now we're going to go to 1 action item, GCM Grosvenor's Private Equity and Infrastructure Annual Investment. Jamie?
Thank you. This item is brought in front of you on an annual basis, and the annual investment plan lays out the management, operations, and investments of the private markets program. I wanted to start by giving you a snapshot of what has happened over the course of the past year. GCM has made 14 new commitments over the past year. This represents approximately $144 million. 12 of those investments were within private equity, and 2 of them were within infrastructure. 7 of the 14 investments have already generated distributions of $4.7 million, and total distributions over the last year were $89 million from 49 investments. And that's 49 of 81 investments. And this represents 45% of total distributions received since inception. What that means is our distribution pace is growing, and that's what we had expected from the program. Since inception, GCM has committed just under $693 million and funded $468 million to 81 investments. 57 of those 81 investments have generated distributions of $200 million, or just under 43% of funded investments. Next, I just wanted to go over the changes for the investment plan. One of the changes, it has to do with the pacing analysis. The pacing analysis has been updated, and it's now anticipated that the program will reach its target allocation of 6.5% by the end of 2016. This is a little faster than we expected to reach that full funding level. It's being driven by the lower overall size of SDCERS total fund, and also SDCERS higher allocation to secondaries and co-investments, which by nature accelerate the market value growth. What this means is that the current pacing is showing that we can expect GCM to commit a little less than we expected over the next 3 years. Though we're expecting to commit $380 million versus what we had anticipated last year of $480 million. But that being said, through active management, GCM will monitor the portfolio for opportunities to exit investments at attractive pricing to deploy additional capital to new investments. The next 2 changes are actually within the investment themes. While we are keeping the investment themes consistent from last year, we're just adding additional language within the co-investments and then the J-curve mitigating strategies. Within co-investments, GCM wants to consider investments in pooled co-investment vehicles. And you might be wondering, what does this mean with the pooled investment vehicles? They're looking to pool capital among clients to achieve economic benefits on behalf of SDCERS and the other clients. The other change is, as I mentioned, within the J-curve mitigating strategies. And here, they want to explore a cash management facility to create efficiencies among capital calls and also to create a slight enhancement of the IRR. In addition to that, as I mentioned previously, they want to explore the possibility of attractive pricing in the secondaries market to see if we can target exiting any investments so we can redeploy capital to new investments. And with that, I'd be happy to answer any questions that you have.
When they were talking about this cash management facility, they were presenting benefits that they thought might accrue to you and them. Do you feel it's an administrative burden to deal with these capital calls, and would this make a difference to you, or is it more sort of?
Is it a lot of extra work? No. Is it extra work? Yes. I mean, it would make things a little more efficient. We would be able to maybe call capital maybe once a quarter rather than maybe every other month or every month. It would create a little more efficiency, and they were thinking it was initially a way to just enhance the IRR a little bit more. So it's not something we've definitely decided on. We're still talking through it, and we'll certainly keep you updated.
So I would just comment that GCM is now our largest active investment that we have, and they're about $530 million, somewhere in that neighborhood. Also returning one of the best returns we have at about 16%. So they've done an excellent job for SDCERS, and we're thankful for that. So with that, I'd like to make a motion that we approve GCM Grosvenor's private equity and infrastructural annual investment plan.
Ready to vote?
I don't think a second was necessary, but we got one.
All votes are in.
Okay, and we voted unanimously to approve that. So number 2, we've already done. Number 3, selection of SDCERS real estate consultant. We spent quite a bit of time on that. We had Aon and Townsend, 2 companies, come in and present, and we made a unanimous decision to move forward to the board with a recommendation of Aon Hewitt, and I'll leave that to Liza to talk about.
Well, I would like to briefly discuss the process, and then Jamie's going to report out the results of the discussion at the committee level. So as a normal course of business, when a vendor's contract is coming due, we usually go to RFP. And Aon Hewitt's contract expires in November of this year. So we issued an RFP in May of this year and received 9 responses. And the investment team reviewed all of those responses and evaluated them on a number of criteria, such as what's the business model, the understanding of SDCERS' needs in the real estate area, the experience of the team, clarity and focus of advice, thoroughness of the investment process, the ability to customize the portfolio to our needs, and we also evaluated fees. Once we went through that process, we narrowed that down to a field of 5 firms. We had those 5 firms come in-house and present to the investment team, as well as Mark was involved in those presentations. And after those presentations, we narrowed it down to 3 firms, Aon Hewitt, the Townsend Group, and Callan, and Jamie and I went and did on-site due diligence to those 3 firms, and what we were looking for was a firm overview and a review of the team that would cover SDCERS, real estate policy services, what their research process was, their reporting capabilities, their compliance and disaster recovery program, and an office tour. And then at the end of that due diligence effort, we narrowed it down to 2 firms, as Bill mentioned, Aon Hewitt and the Townsend Group, and they presented yesterday. We had a rigorous discussion, and Jamie can summarize.
Absolutely. What we To start off, both firms are extremely qualified, and they did rise to the top during the RFP process. I think that's extremely important to mention. The committee did have a thorough review of the merits of each firm. However, I think that the committee felt that the organizational and management changes that Townsend is currently working through poses too much risk for SDCERS right now. There's just too much uncertainty with their situation. Aon Hewitt has been working with SDCERS for the past 5 years and has brought a lot of value to the real estate portfolio. At this point, there is no compelling reason to switch real estate consultants. Some of the main reasons that Aon Hewitt did rise to the top during that RFP process are that they have a very customized, repeatable process that is tailored to each client's needs. On an annual basis, they review the policy. They do a manager structure review of making sure we have the best managers in place. And then they have that annual plan that then we can work through, and we know exactly what our plan is for the upcoming year. In addition to that, they have a thorough, focused research process. They start with a macro overview of the universe, and they really try to focus on the strategies that are best for that particular point in the cycle. And that, we thought, was a definite advantage to what we were seeing from other consultants. And finally, they bring their best ideas forward to clients. Aon Hewitt brings their highest conviction managers forward and then engages in discussions with staff to find the best opportunities for the real estate portfolio. And with that, we'd be happy to answer any questions that you might have about the process or about Aon Hewitt and their capabilities.
I think, yeah, Carol, go ahead.
Do you want to mention the issue regarding Kate and asking
Yes.
for more of her time?
Absolutely. So one of the concerns that the committee had, right now we have Che Hong serves as our lead consultant for this RFP. They have proposed that it would be a joint co-lead between Kate Pollies, who is the head of the real estate group, and Che. We felt that we wanted a little more attention from senior leadership on the team, and Kate would be that person. We're thinking of writing into the contract that she would have to attend 4 of the 6 meetings per year.
I think it was unfortunate for Townsend that they'd just gone through an acquisition with North Star, and then another company came in, Colony, and now they're acquiring. So I don't know. It was the organizational changes were too much. So with that, no questions. I'd like to move that we approve the selection of Aon Hewitt as our real estate consultant.
Ready to vote?
Do you want to change the motion to say?
We can.
Oh.
We need to say selection.
Oh, yeah, well, we got it. I think we all need to go backwards a bit because the motion doesn't capture Aon Hewitt.
Yeah.
We can do that right now.
Okay. So technologically, we ended that vote before it was tallied, and we're going to re-motion
Okay.
with Aon Hewitt.
Okay. All right.
There we go.
Not for the IPS.
Okay.
All right, let's try this again. Bill? There you go.
I did it.
No second necessary.
Now ready to vote. All votes are in.
And the vote passes unanimously. Okay, now we'll go on to item number 4 under action requested, which is recommended changes to SDCERS investment policy statement.
So this is something that we review on an annual basis. It was reviewed this year by Aon Hewitt, the consultant, as well as K&L Gates, which is our outside legal counsel. And I'm just going to highlight a couple of the major changes. On page 2, we've changed a little bit of the language. You'll see in item number 3 in the middle that says to diversify the investments of the fund so as to achieve a fair risk-adjusted rate of return that will support the long-term soundness of the trust fund. We changed the language there because the consultant, as well as the outside legal counsel, felt the old language had the potential to encourage imprudent risk-taking in that if the goal is only to hit the actual rate of return, that might not be appropriate. So again, under investment goals, slightly different language under the first bullet point, generate returns that support the long-term soundness of the SDCERS trust fund. Then if you turn to page 5, this is the red line version I'm talking about. Under asset allocation policy, they just added some additional language which highlights the importance of asset allocation. So you can see that there on page 5. And then on page 7, we've updated the real estate benchmark to only be the NFI Odyssey plus 50 basis points, and that is a reflection of the elimination of the global REIT mandate. So that's an update. They've also added a bit of additional clarifying language on the benchmark for private equity and infrastructure in the middle of that page. And then on page 8, they have added that the general consultant will take on an annual liquidity analysis for the plan and present that, and that's because we're a partially closed plan. So I would be happy to take any questions.
Could you go back to the investment goals, the first bullet? What did it say before the change? Because I understand what you're saying, but it just is so vague. I wonder if we could make it a little bit more specific.
The lawyer wrote that. It's vague.
The first bullet under investment goals?
Yes, it used to say SDCERS should earn on a long-term average basis a rate of return equal to or in excess of SDCERS's actuarial investment return assumption.
Yeah, I guess my problem is it's so vague, it doesn't mean very much to me, the way the bullet is. But maybe that's lawyer speak, I don't know.
No, I mean, what's the point of setting the target if we're not going to try and hit it?
Exactly, and this doesn't say that, I don't think.
Yeah, I mean, I understand what the lawyer was doing, but I don't think it makes any sense from an investment policy statement. But then again, what do I know?
Well, I think the goal of it was to get away from saying, look, the target in asset allocation is to earn the actual actuarial rate of return. Gene always says that. That is not supposed to be the driving factor in determining your asset allocation. So I think that was the reason for moving away from that.
There's a relationship, but they shouldn't be in lockstep
Right.
necessarily.
Also, what do you mean by soundness? Maybe if we just define soundness, that would help.
Yeah, the actuaries avoid that one too.
Well,
They won't
yes.
touch that one.
In my opinion, soundness is the ability to pay benefits.
I mean, if you just simply added to it, if you added to the change with the hope of achieving the stated return or better, I guess my question is that we certainly know what the expected return is. We hope like heck we're going to get that. I understand that that's not the exclusive issue, but if I'm going to I guess my question is when you guys go out to the money manager and you say, hey, I'd like you to invest this money. We have to share a target with them, right? I mean, we have to share what's going on with them.
Mm-hmm.
We're not doing this in a vacuum. We're not putting blindfolds on and going, what do you guys think? Let's play spin the bottle. I mean, we're telling them, hey.
Well, we don't necessarily tell them, but we know what we're kind of shooting for.
Well, I mean, that's the other side. The appropriateness of the investment, if you say I need to make 7%, they say, well, you can't do it doing that, or you can't do it safely doing that, or I mean, you have to have a target to shift off of somewhere.
You know, Natasha just made a point to me offline, and I think if you read the paragraph above with the first bullet, it kind of takes away the concern I had. I was reading it just out of context. And I think the paragraph above kind of defines what we're trying to do.
That to generate adequate long-term returns that, when combined with employer and employee contributions, will result in sufficient assets to pay the present and future obligations of SDCERS.
And with that, the first bullet now makes more sense to me. I was reading out of context, so I'm happy.
Okay.
Thank you.
No other comments?
The only thing that's not in there is anything about cash flow. And maybe it shouldn't be at this.
Well, the investment program doesn't necessarily control outflows, right? So it's not under her mandate to.
The manner in which the portfolio is invested is influenced by how much short-term and long-term, what our cash flow needs are.
But again, I
Yes, sir.
think that's covered in the paragraph.
Covered in the paragraph above.
Yeah. It's an all-inclusive paragraph.
It'll
Laura
become
did
more
a
of an
good
issue
job.
once the cliff happens.
I was going to say, we heard this
Exactly.
morning about things that caused that to come to mind, so.
And which is why we're going to have a liquidity analysis.
Right.
Good job reading that paragraph.
Okay, so I'll go ahead and move that we approve recommended changes to SDCERS investment policy statement.
Push the button there, Bill.
I don't have the button.
Oh.
Let me,
Always an
let me
excuse.
just, there we go, okay. Did it do it?
You broke it again, Bill.
All right, try it again.
Okay. There we go.
Go. No second required.
Well, Bill, since the committee didn't talk about it, you technically need a second. So if someone would give a second, thank you.
Oh, that's right.
Ready to vote? All votes are in.
And that passed unanimously. Okay, now we'll go on to the no action. And the first item there is review of the SDCERS Securities Lending Program. We had John Murin, who talked from State Street, talked us through that.
Just a few quick comments on that. Again, we have an annual review of our securities lending program. We have earned, since inception of the program, which began in March of 1998, a little over $28 million. Year to date, we've earned in excess of $660,000. We have 8 portfolios enrolled in the securities lending program in U.S. equities, corporate bonds, U.S. government bonds, and non-U.S. equity. And that's pretty much it.
Okay, no comments on that. We'll move on to the GCM Grosvenor Private Equity Infrastructure and Performance Report.
Great, thank you. You have in front of you the performance report for the quarter ending March 31st for GCM Grosvenor Pacific. Starting on page 2, as you can see, the market value for the GCM Grosvenor Pacific Fund was $447 million. This is an increase over the previous quarter of $21.3 million. During the quarter, GCM committed to 3 new investments totaling just under $34 million, 2 within private equity. One was a primary and one was a follow-on co-investment, and the other within infrastructure, and that was a seasoned primary. During the first quarter, the fund distributed $32 million, bringing total distributions to just under $175 million since inception. Moving on to go over the performance here. I want to give you a little bit of a background on the markets. Brief, I promise. So as we know, in public markets, the first quarter was a volatile time. Private equity was not immune to this volatility. The Burgess Private IQ All Private Equity Benchmark, that is a mouthful to say, was flat for the quarter at a negative 0.1%. However, the GCM portfolio performed just in line with that. The combined net IRR to SDCERS was 16%. Breaking that down further, private equity had a IRR of 17.2% on a since inception basis, and infrastructure had a net IRR of 11.9%. Just to give you a little bit more market commentary, the private equity markets, there are 3 barometers for health: private equity fundraising, initial public offering issuances, and the level of M&A activity, and all of those declined. So for our portfolio to stay steady throughout the quarter was a good indication of its health. And with that, I can answer any questions that you might have.
They had a couple interesting investments. One in which was a Japanese company or pension fund that was unloading, and they basically got one of the investments for free. So it gave them a really big return when they took it on. Okay.
Doesn't like free.
Arigato gozaimasu. So we move on to StepStone's private equity infrastructure performance report.
Yes, similar story here. As of March 31st, the estimated market value in the StepStone Atlantic Fund is $416.4 million. This represents an increase of just under $31 million since the previous quarter. During the quarter, the fund made 3 new private equity investments, totaling $22.2 million. 2 of those were in private equity. One was a secondary and one was a co-investment. And the other was within infrastructure, and that was a co-investment as well. During the quarter, the fund distributed $2.7 million, bringing total distributions to just under $109 million on a since inception basis. And then to talk about performance, as I mentioned previously, first quarter was a volatile quarter for the markets and for private equity. That benchmark, again, was a negative 0.1% during the quarter. But breaking that down into its sector components, we saw a mixed bag among those sectors. There were modest gains in buyouts and mezzanine that were offset by declines in energy and venture capital funds. There's a point to that. I'll get to that later. But looking at the returns, on a combined basis, the net IRR since inception was 13% for the portfolio. That has come down a little bit since the previous quarter. Breaking that down further, private equity on a since inception basis has an IRR of 16.3%. This is primarily can be attributed to the mark-to-market adjustments for some of the investments for where we are in the cycle. However, for infrastructure, you can see that the IRR is now negative at negative 1%, and that has come down 350 basis points since the previous quarter. This decline can be attributed to the infrastructure portfolio's concentration in the energy sector, particularly within oil. On a macro level, in the first quarter, crude oil prices reached a historic 15-year low at $26 per barrel. The price has since recovered, but has remained volatile. Within the infrastructure portfolio, 3 of the 14 investments are the most challenged and impacting performance the most. Those 3 investments represent $24.5 million, or 46% of the infrastructure portfolio. These investments are within the exploration and production and oil field services sectors, and these sectors have been the most impacted in this most recent market volatility. The valuations for these investments are being held at conservative values, but StepStone believes that there is still time to recover, for the values to recover. What's important to note here is that infrastructure represents a small percentage of the portfolio today. Infrastructure represents $103 million out of $580 million in committed capital, or approximately 18% of commitments. Infrastructure is still being built out, and when the portfolio is fully built out to the target allocation, we would expect the infrastructure to comprise approximately 30% of the portfolio. In addition to that, oil and gas is a large percentage of the infrastructure portfolio today, but this will moderate as more investments are added and will obviously diversify the portfolio. StepStone continues to believe that the best opportunities remain with an emphasis on secondaries and co-investments while targeting value-add opportunities with higher returns. And we would say that those returns we're targeting are above 13%. They'll be looking for investments to further diversify the infrastructure program in power generation, water, transportation, telecom, and data centers. And with that, I'd be happy to answer any questions that you might have.
Yeah, when you think about it, the oil price went from about $100 a barrel to $26 a barrel, so it really took it one huge hit on that. But it's coming back. It's around $46 a barrel now, and they've kind of worked. Most of the oil and energy firms have either taken their hit or they're now working through it, and it'll be a longer-term exit for them. Okay. The next item on the list is Aon Hewitt's Real Estate Performance Report for quarter end March 31st.
Yes. Okay. You have in front of you the real estate performance report for the quarter ending March 31st, 2016. Total number of investments that we have in the portfolio currently are 23, with a market value of $781.4 million. You'll recall the target is set at 11%. On a funded basis, the portfolio is currently at 11.5%. You'll recall that this funded allocation has increased since the previous quarter, and this is primarily due to the reorganization of the funds between the real estate and opportunity funds, which was approved at the July meeting. Sorry. Anyway, the Brookfield portfolio has also was part of that same vote, and they have been given formal termination. When that moves through its process, the portfolio will reduce the funded allocation to 10.3% once that has taken effect. Moving on to performance, you can see for the quarter, the real estate portfolio has had a return of 2% versus the benchmark at 2.4%. And this was primarily driven by the global REIT portfolio and its underperformance during the quarter. Over the longer term, you can see for the year, it's a very strong return of 13% versus the benchmark at 12%. And over the longer time horizons, SDCERS continues to perform in line with its benchmark. And with that, I can answer any questions that you have. Yes?
No questions?
Not a question, just an observation that the quarterly return for the index is, at least based on this one quarter, is sort of reverting to the mean. And
Absolutely.
Returns have been really strong for the last 5 years. But, that's, I would think, an expected
Absolutely.
phenomena and still a very attractive return.
That is a very important point. Actually, this was the first quarter that we had seen that income outpaced appreciation. And that's the first time it's happened since, I think, before 2010.
Okay.
We can expect those returns to moderate.
Yeah. All right, and then finally moving on to Aon Hewitt's total fund performance report for the quarter and fiscal year ending June 30th.
All right, if you turn to slide 4, the total fund performance summary, you can see the fiscal year in review. You can see this is basically the S&P 500. Obviously, it was a very volatile equity market. We had 2 major corrections during the course of the year. One with the collapse of the Chinese stock market, and then later on in the fiscal year when oil was falling and there were concerns about global growth. And then, of course, right at the end of the year, we had the Brexit, where you can see that sharp decline, although the market mostly recovered from that, as well as international markets. You can also see the green line, which is the yield on the U.S. 10-year Treasury, declined from close to 2.5% to about 1.5%. That's at an all-time low. And that's basically a result of, during this volatile period, there's a flight to quality where investors are piling into investments that are considered very safe and secure. Turn to the next slide. This shows you kind of the mixed bag of returns in terms of different asset classes. U.S. stocks were generally positive. The S&P 500 was up 4%. The Dow Jones U.S. total stock market was up 2%. I'm going to talk a little bit more later about attribution. Our stock exposure was actually down 0.9% compared to those 2 benchmarks. We had some negative returns from our small cap bias and a couple of our active managers. Then you can see the Russell 2000 index. That's the small cap index. That was negative. The EFA index, which is developed non-U.S. markets, was negative over 10%. Emerging markets, even a bigger negative there. Then you have two bond indexes, which were positive. The next two, the first one, the JP Morgan GBI EM Global Diversified Index, is a local currency index that was up 2%. The one after that is a US dollar denominated index that was much more positive because the dollar rallied during the course of the year. And then you can see the return on the 10-year US Treasury with the yields falling. As yields fall, prices go up. So there was a gain of 9.5%, which is pretty astounding. What this does not show is some of the returns in the alternatives market. So as Jamie said, our real estate return was 13% versus a benchmark of 12%. And then on the PE infrastructure side, we had an 8.5% return. Then turning to slide 10, this just gives highlights for the year. We ended the fiscal year at 6.8 billion. I wish it was 68 billion. The total fund returned 1.1% versus the custom policy benchmark of 2.3%. As I said, the underperformance was relative to its benchmark was mostly from active manager performance and the small cap equity bias. Longer term periods were earning 6.8% over the 3 and 5 year period. Longer term, we are earning over the actuarial rate of return. And I would just mention that even though the 1.1% return for last year is a pretty low number, that actually put us in the top 30th percentile compared to other public pension plans. So it was a tough year all around. Then total fund returns on slide 13. You can see what the returns were for the quarter, the 1 year, 3, 5, and 10 years, and since inception numbers. Then turning to slide 14, this is a new chart that the consultant has put in here. And basically, this is to look at the risk versus return in the portfolio. The 78-22 global equity to international bond mix, if you will recall, is our mix of return-seeking assets to risk-mitigating assets. And then when you look at the little triangle and the square, which is the total fund policy benchmark and the total fund, basically what this is telling you is that we've earned a higher return with less risk than the 78-22 mix, and that's a good thing. And then the next slide gives you our comparisons in our total fund peer universe. One of the things that actually Mark asked us to include in this page was a 20-year return. And you can see our return for 20 years is 7.8%, which puts us in the top 5th percentile of returns in this universe. And Mark, I think, has also made the comment that compared to some of the other really big plans like CalPERS and CalSTRS, they're not beating their actuarial rate of return on a 20-year basis.
Yeah, we hadn't seen much in the press about a 20-year return. I just thought it noteworthy this year when PERS and STRS released their numbers, they showed a 20-year mark not hitting their actuarial return expectation, and of course we are, so I thought that was worthy of pointing out.
Mm-hmm.
If we look back at 20 years, what was our actuarially expected return?
Well, it was a blend, right? So we were expecting 8 for part of it, now later.
Right.
So it probably would be close to that on a weighted average. Yeah. But compared to our current number,
yeah,
you know, like,
I understand that.
Yeah.
I'm just curious on the 20-year basis how they compare.
I think the 20-year number for PERS and STRS was closer to 7, and their assumption is closer to 7.5 currently.
So the last chart I'd like to cover is just attribution. What led to the underperformance versus the benchmark. And you can see the green bar is the allocation effect. That is basically whether you are underweight or overweight an asset class. In this case, that number was driven by the fact that we were slightly underweight our real estate allocation, and that was one of the best performing asset classes that we had. Then the selection effect, which was a negative 77 basis points, was really driven by some weak performance from active managers, specifically Dodge and Cox. underperformed their benchmark by a little over 7%. They were overweight financials on the expectation of higher interest rates. That did not materialize. They were also underweight REITs and utilities, and that hurt their performance as well. And then, of course, the small cap bias. Small cap stocks did not do well last year, and that's a result of volatility in the market. And when there's volatility and uncertainty, small caps, generally speaking, don't do well because there's more perceived risk in smaller companies. So that hurt us. So that really summarizes my comments on fiscal year performance, unless you have any questions.
Liza, I have a quick question, and you can answer it later. I'd be curious to understand what is the makeup of the custom policy benchmark, particularly for U.S. equity, but then also more broadly.
I can get you the specifics, but basically what it is it is taking all of our asset classes and our target weight and saying, using indexes to come up with the policy benchmark.
Yeah, I was just curious, sort of, are they modeled off a market cap weight to like a Russell 3, for example, for the U.S. equity?
No. I can get you the specific details.
Okay.
Of all the different components. Yeah.
I think the most astounding thing that happened last year was that the 10-year Treasury hit an all-time low, and it's down around 1.5 something now. And what that really tells you is that there's a real flight to safety, and that globally money's coming in to the U.S. because we're the safest place to put it. But it doesn't bode well for the future. That's the problem. Is that's a predictor of the future. So future GDP growth globally will probably remain low for a while. Okay, and then we'll move to the Investment Division staff report.
Okay, very quickly and for the record, the reconciled market valuation of net assets as of June 30th was $6.791 billion. Since the prior board meeting, approximately $11.4 million was wired out to make payments and operating expenses, and 2 wires totaling approximately $71.5 million were sent out in June and July to pay monthly benefit payments. And that's all I have.
Okay, that's it for our report.
All right, thank you, Bill. Training.
Thanks, Alan. I got 2 requests from Thanasi to attend 2 client conferences. Aon Hewitt's conference next May, and then in November, Invesco Real Estate.
Johnny already told me that it's like Christmas lists. Yeah, I can write it down, but it may not happen.
All right. Did you get permission from your wife?
You have another one?
Can we add some
Okay.
emotional stability training to Tanasi's?
Thank you. My wife thanks you.
It's already been approved.
Actually, I just went for the Aon Hewitt
I don't know if it was. It's on the training schedule.
Carol Broad.
Instead of?
Thanasi and Carol Broad. Right.
Did we vote on that? I guess I don't know.
We did vote on the plan last time. We just got a date.
Right. Oh, gotcha, okay. So I'll have that too.
You as well?
Can go twice.
Can
Yeah.
you also add Natasha Kalora to the Aon Hewitt client conference?
What's the?
It's part of my plan with
Yeah.
John, was that May? We went to Chicago 11th or something like that?
May 16th through 18th.
In Chicago?
2017 in Chicago.
I'm not sharing a hotel room with him.
I might want to keep tabs on Tanasi. Hold on.
I'll need a first and a second.
I need a button.
Yes.
Wait, do you want on that?
Uh-huh. I think so.
Johnny,
Ready to
I think Val wants on that one.
You can withdraw it, or we can do Val after
I can
this.
just go separately.
Okay, why don't we vote on this and then we'll put Val in.
Somehow we have different screens up. Carolyn's screen and my screen are different.
Yeah, mine didn't have the Aon kind of came Aon what?
Which he's got a different motion.
You're saying if you press yes, it might look different.
No, it shouldn't, the motion
I know,
shouldn't
that's what
change.
he-
Let's not
That's
quibble
what I'm
about
saying.
what the motion is. Let's just vote on it.
First, we have to.
All right, so should we just move on with the manual vote?
Sure.
Yeah.
Okay, so there's a motion to approve Tanasi to attend the Invesco Real Estate U.S. Client Conference number 8 through 10 in San Diego. I made the motion, second by Karina. All those in favor of approving Tanasi's attendance? And it looks unanimous.
I had to abstain.
Oh, did you abstain?
I abstained.
Okay.
Tennessee's
so-
wife voted twice to go.
Yes, yes.
3 times.
Yes, but it's in San Diego, so she's not going to get much. Yes.
And then I'm requesting to be allowed to chaperone Tanasi to the Aon Hewitt conference in May.
Alan, do you want to read that vote then?
So, that, the last vote?
The next one.
The next one. Okay, so there's a motion to approve. I'll move for Val to attend the Aon Hewitt Conference. Where was that again?
This is Aon Hewitt in Chicago, May 16 to 18. Is that right? Yeah.
Okay.
I'll second it.
And then Bill will second that.
I don't know what's going on here anymore.
And
One moment.
those in favor of it,
Do you want to type it, or do you just want to?
are we going to go manual or are we typing?
We can just do it manual.
Just do a manual, Alan, please.
Okay. Those in favor of approving Val's attendance?
Val's attendance, yeah.
Okay. Thank you. That was, is that unanimous? Or did you abstain?
abstained.
You abstained, okay.
That's it. Thank you.
Okay. All right, so that brings us to the end of the agenda. Any questions, comments?
No, we
from-
still have, we didn't vote on the audit committee compensation.
Oh, that's right.
And I think
Good.
B&G, we have a vote.
No, I think we did all our B and G votes.
we got the
do
B&Gs
B&G. So,
vote.
yeah, so we have to do the, that's right, the internal auditor's compensation.
We're doing this a little differently, given we've got 3 performance reports in closed session. So
Right.
if you look at your agenda, it's a little tweaked in that we're coming back out of closed session to vote on those items.
Right.
Since it makes more sense to me to talk about the performance and then salary later.
Gotcha. And
So-
that is typically how we do that. So what we'll do is we will now go, if there's no questions or comments from anybody on that agenda item, we'll go into closed session. We'll discuss the performance reports and we'll come out and discuss and vote on the compensation.
Yes.
Okay, awesome. Thank you.
Mark emailed you my short self-evaluation. It's just a laptop.
We actually
already
did-
got it.
We actually took care of both.
We already took care of both.
Oh, you
Took care of
took care of both?
Yep.
Oh, okay.
We did
Let's
both
go.
evaluations.
Do you want to go in open?
We're going to open session.
Don't leave the room if you're worried about what happens.
Alan, you just got that one thing to report out.
Yep,
okay?
I got it. I have my script.
That was awesome. He was my hero before, but now he's at a whole new level.
Deadline. All of a sudden, stuff's getting done real quick.
Isn't that interesting? You wonder how many people.
Too bad Gene didn't have to catch a plane like at 9:10.
Oh my God, could you imagine? Jeez.
Okay, you want to do leave first? That'll be quick.
What's that?
Want to do?
Okay. All right, coming out of closed session, the only item to report out is the board voted unanimously to have attorneys Dave Noonan and Steve Sanchez defend SDCERS in the Goodman versus SDCERS lawsuit. And with that, our next agenda item will be the discussion of compensation for the internal auditor. So
Okay.
Ed, I'll go to you.
The board met, and we actually had a very robust discussion. Lee, right now, Lily, what's, okay. Lee right now is at, Lee right now is at 135. Lee was hired at 125 in September 13. In 14, we didn't give him any increase. We wanted to have a little bit more of a track record. Last year, in September of 15, we bumped him $10,000 to $135,000. The committee voted to give Lee a 3.5% salary increase, which I don't have in front of me. I think it came up to whatever 3.5% of 135 is. I think it was like $4,000 and something dollars. $4,700.
Do we need a motion?
Yes.
Wow.
So-
Well, I'll make the motion that we raise Lee's salary 3.5%, and we looked at the pay schedule, and I think that will be effective September 10th, if I remember correctly, on the
Correct,
pay
yes.
periods.
You don't need a second since it was.
Out of committee.
Are we doing this by hands or are we doing this by machine?
Do we want to adjust the wording?
Were there any dissenting votes at committee?
Yeah, that's what I was asking. Do you recall what the vote was at the audit committee?
The vote was
Yes, there was one
unanimous.
person. It was,
Wasn't it?
there was one person,
Oh, there was one abstain.
yes, David
It wasn't
Kramer.
a dissenting, it was an abstention.
It was, yeah,
Yes.
and no reason was given for the abstention.
Okay.
Can we vote electronically, or are we voting by hand?
We can vote electronically if you give her a second to
Okay.
put up the correct language.
Maybe we just vote by hand, because we're running out of time.
Yeah, we got, all right, so we have a motion by Ed as audit committee to approve a 3.5% salary increase for the internal auditor. Those in favor of that motion? Show of hands, it's unanimous, okay. Next item up on the agenda will be discussion and consideration of compensation for chief executive officer. All right, Mark.
Same if we take it all away from him.
This is open session.
So Luli, do you want to
Yes.
kind of brief us on this?
Absolutely.
I mean, brief?
And you've already received the table, right? So I just want to go through the table real quick. The salary table that I've passed out has 3 different sections. The first section, it includes 4 comparable pension systems in California, and the table's in order by fund balance, highest to low. It includes how many budgeted staff they have, base and non-base, which non-base is really only auto allowance, and the total, of course, base and non-base. The section 2, which is Orange County and San Diego County, those are 2 of the larger pension systems in California. And then the next section, which is San Mateo and Marin County, those are 2 smaller ones.
Okay, so the information that I collected was from the Calipers 2015-2017 salary survey. So they do that every 2 years, so it's not always up to date, but that's the information we have. That's one of the sources. I also called on, as you can see, the first section, every agency that has an asterisk, those are agencies where I talk to the HR professionals and we actually discuss this so that I know that data is absolutely current and correct. Additionally, some of the ones that have the double asterisk, that's just Transparent California, and that's because the agency either didn't respond to the voicemails, emails, and that's the best data that I could get, okay? Also, there are 41 pension systems in the state of California, and SDCERS is 13th in size of largest size.
Is that based on staff or based on, is that based on staff or is that based on?
Assets.
Assets.
Yes. Let's see here. Of the systems surveyed today that you have in front of you, SDCERS has the maximum number of tiers, which is 27 tiers, and makes the system much more complicated at times and requires greater accuracy. Orange County, the CEO received a $5,000 bonus that's not included in the total comp. SDCERS board last year, or the year before, I'm sorry, approved a 5% salary increase per year for the CEO, and they're on their third year this year. And then the data that I used for Alameda County, which is in the first section, the CEO recently retired. That data I'm using from the recent retiree because that person had about 4 years in that position, and there is somebody new in that position now, about 3 months. So that's the data that I used as more of a comparable.
All right, Lily, I think Natasha has a question.
Just have a quick question.
Oh, sure.
The non-base salary, what is that?
So the non-base salary for this survey is only the allowance, car allowance.
Okay, and his is the lowest.
Yes.
What are the other benefits that other CEOs are getting?
Benefits, you mean aside?
Non-base, is it all car?
Yeah, this is
Is it
all.
all just car?
All of this is just car.
Comparison car to car?
And the reason why they're so different, because some actually have an actual vehicle, and others just get a certain amount per month, say $1,000 per month. Some of the agencies that you see here, they'll get a $1,000 car allowance per month. And so but basically this is solely just car allowance. No bonuses and nothing else is attached to that.
Can you give, I'm going to short circuit your presentation here for time reasons, Lily, I apologize.
That's okay.
Could you give us a quick overview of his history of raises going back the past few years?
Okay, so Mark has received a total of 10% pay increases in the last 6 years, which is an average of 1.7 per year. And let's see, and Mark was appointed to this position. He came to the city in July 30th of 2007, and he actually became the interim CEO in December of 2009. His current salary range, which is, the salary ordinance, is $73,000 to the high range, $292,000.
What was the amount of his last raise?
His last increase was July 4th, 2015, 5%.
So last year.
Or last year.
Not doing a good job.
And that would be a 3.5% increase.
Yeah. I'll make that motion.
Which I'm comfortable with.
I
yeah.
agree.
I was comfortable, I thought we should have done more for him last year, and I would be comfortable going to 5%. I don't think getting to an average, I think that's rather arbitrary. Of course, anything you could argue is arbitrary, but I'd be in favor of giving him a 5% raise.
So.
I did want to make one more mention, and that was, we've talked about the current average salary, but the car allowance is the lowest among, as you've noted. The average is $10,332 for the entire group. The lower, the larger, and then the median.
Mark really doesn't have to use his car very much for business also.
He'd still be, if you gave him a 5% raise on his total comp, he'd still be under the average in that category.
I just have a question on the car. His parking's already covered, correct?
No.
Oh, he pays for his own parking?
Well, he commutes. So his parking isn't covered. He doesn't park in this building. He commutes. He uses the train, and as needed, he drives in, and he pays for his parking when he drives in.
Sorry, just before you say that, the only thing I want to be careful about is, we just gave Lee a 3.5% increase, and I think he's doing an excellent job. What message are we saying when we are giving the CEO 5% against the 3.5? I'm just asking the question. I'm not suggesting one way or the other. I do absolutely understand that Mark is on the low end of his peers, I think. So I guess my difference would be, I'd almost rather, if we're gonna try and get him to where we think he should be, that's one thing. If we're gonna give him a raise for cost of living or whatnot, I'm struggling with why it should be more than 3.5%.
Your question is actually should be a little deeper, and it's not just Lee, but what about all the other executives?
Exactly.
Well,
exactly.
and on your point, I mean, on Lee's compensation, I felt that Lee was at that point where naturally an employee would receive like a step or a merit increase for their time here, and Lee's pretty much at that time. But in consideration of the other employees, I would agree. The other employees haven't had a pay raise since 2008.
Right.
And so handing out pay raises to the supervisor, and we talked a little bit about this type of stuff, about leading the organization. I appreciate all the work Mark does. I think he does a very good job. But honestly, when I look at the chart and see him in the middle of the similar size funds, I think that's a good, comfortable place for us as a board, and both from a effectiveness stage for or position from him, and from honestly a political position of keeping him in the middle.
You know, I've heard you
don't
make
wanna
that
be
argument
really-
year after year after year to cap what Mark makes. And he's not in the middle. He's at the bottom. He's at the bottom of the pile, running a bigger organization and doing it extremely effectively. And so I appreciate that there are limits on what people get paid within the city. And I struggle with that too, but that's not my call to make. I got one decision to make, which is, what do I pay the CEO? Just taking that decision, which is the one that I can control, the only reason that would matter to me is, are people going to be pissed off that Mark gets a 5% raise? Are they going to be thinking that that was wrong because they didn't? I guess my response to that would be, they're different systems that we're going through, and if anybody thinks that way, I think they ought to go have a nice talk with themselves. Mark is taking of all the people on this list, if you look at total compensation, Mark's at the bottom except Sacramento. And frankly, Sacramento is a whole different animal and is always at the bottom of all of these lists. But if you look at any San Bernardino, Contra Costa, Alameda, Orange County, San Diego County, San Mateo, or Marin, he's at the bottom of all those lists. He's not in the middle. And I think you belie a certain prejudice when you say he's in the middle. I think that's just arguing to a result because you're unhappy that salaries in general have been stagnant and frozen in the city. And I'm unhappy about that too.
Well,
but I still think our CEO ought to be paid fairly.
And I agree. And I think everybody in the city should be paid fairly. And so if we're going to argue that we're going to base Mark's compensation in comparison to other agencies, then the city of San Diego, and I would encourage you to have this conversation with the council members and the mayor, that the people in the citizens of San Diego or the employees of the city of San Diego should be compensated on that same scale.
Don't disagree with you.
But that is not the conversation. So I have a problem from an organizational standpoint of giving the leader of the organization effectively 15% raises over the past few years when the people he's leading have got nothing.
And I think you're going to support the status quo of keeping everybody's salaries too low if what you say is that the leader has to stay down there and can't be compensated fairly compared to other counties, people in the same job, maybe even smaller jobs in other counties.
I think it creates a morale issue within SDCERS.
I'd like to clarify. Yes.
And does he get that taken care of?
He pays for that. No, so he pays for that through his reimbursement. So he does pay for that. This is what he gets, but
Maybe we give
yeah.
him $2,000 car allowance and take that up to 5, and that gets him.
I got to tell you, I'm.
The 235 puts him
Yeah, in the one column, but not on the other.
And I got to tell you, I'm not in favor of that. I'll tell you why. I think that that's a game that gets played with compensation. I think we should state his compensation in the column and pay him what's fair. And I have a problem with increasing the auto part when he doesn't use it. Now, my issue is, I got to tell you, I'm in agreement with Val. I don't think he's being properly paid. If we're going to try and take him to proper pay, which in my mind is somewhere between 245 and 255, that's one thing. If we're saying, hey, we're going to give him a COLA adjustment or whatnot, and the rest of the staff isn't getting it, and Lee gets 3.5, I have a problem exceeding 3.5. I do not have a problem properly setting his compensation. I don't have a problem with that at all, because what we're acknowledging there is that this guy isn't being properly paid for the system, the complexity, the whatnot, and we need to make an adjustment to that. And I understand that might be a distinction without a difference, but it really makes a difference to me. I think we should figure out what his fair salary should be and pay it.
You know, for what it's worth, I made the same argument for Lee that you guys are making for Mark. And I said, let's look outside pension plans, but look what an internal auditor is making, outside. He can make a lot more money. And I could just tell you, my other three members just shot me down. Eventually, I came to their way of thinking, but I made the same argument.
But when you make the argument outside of public service or outside of employment by a pension fund, I think you introduce a lot of variables to the job that make it different.
But you use the term market value.
Yeah, but I'm limiting the market to public employee pension systems of a similar size and nature because...
And in California.
Because I do feel that is an appropriate market limitation.
The market also is what can Lee go if he walks out the door.
But that's why chief investment officers often make more money than chief executive officers in these organizations.
And my clarification point was in reference to, Ellen, I think you were talking about salaries. And so within the city, not just our department, because within our department, SDCERS, we have given employees, executive team members, as well as unclassified managers that are not part of the executive team, have gotten pay increases that range anywhere from 3 to 6%, maybe in a 2 year. So maybe this person didn't get a pay increase this year, but they did get one next year. Okay, so that not exactly across the board. So I'm averaging it for you.
So here's when the employees go in for a pay raise, the city does an actuarial analysis on the impact of their pay raise. Is this board willing to adopt that same process and say, okay, we're going to give out pay raises that exceed our wage inflation assumption, 15% over basically 7 years, of which we don't have a wage, and except the
1.7% per year.
I mean, I want to make sure we have the correct number because you've said a different number than she said.
So are we willing to accept the fact that we're going to have a wage increase last year and this year of 10% in 2 successive years, 5% in 2 successive years, that far exceeds our wage inflation assumption and create the unfunded liability associated with it? That's the discussion that occurs with the rest of the city and the rest of the employees in the city. So if we are going to have this conversation, I am not going to exclude that element of the conversation.
But I think the problem is that's where I think you're mistaken there, because we're not talking about pay increases. We're talking about properly setting the CEO's salary, and that requires a number of things. What happens when what happens when San Bernardino or whoever else calls him up and says, "Hey, come to our system"? What happens when David Wesco says, "I'm leaving. Why don't you come over to wherever?" The man, he's dealing with 54 employees, a fairly complicated plan. I don't know that his salary is properly set. What I am not saying is that 10% a year is a fair salary increase. I would not agree with that. If he was being properly compensated, I would not agree with that.
Depends on where your base is.
Right. Yeah.
Where you start from. And where we're starting from is, I think he's undercompensated compared to his peer group. And I would like to get him closer to fairly compensated compared to, and Alan, if you don't mind my saying so, I appreciate your comment that there may be some people who are resentful of that. And I guess what I'm saying is, but they're wrong. And you included if you're resentful of it. That's not the right way to approach this decision. This is a board making a decision about what a CEO gets paid, and that's a market-based decision, and that's really all it is.
Yeah.
And I appreciate your opinion, but I wish that was the reality of working for the city of San Diego.
Yeah, you have employees that haven't seen pay raises since 2007, and they are well above their market value, and they certainly aren't being compensated appropriately.
You mean below their market value?
No,
Nobody in the city of San Diego is being paid market value.
Well, what Tom just said was above their market value. I think he meant below. They're paid below.
Yeah.
But
and,
we
and
have
I
no control
appreciate
over that.
and I can't change that. And
But-
I don't
but
think it's,
Alan-
and
Alan's-
it goes back to the old two wrongs don't make a right. It doesn't solve the problem for us to say, hey, let's risk losing our really super CEO because we don't want to raise
But see,
salaries. 'Cause
that whole
somebody else-
mindset is why there's so many police officers leaving. They're going elsewhere.
Right, and I would like that
and
to
we're
not
suffering
happen.
because of it. The
I agree.
city's suffering.
So let's set the right example for the rest of the body politic. Let's do the right thing.
You know, the one thing that's not in here when we talk about Mark's compensation, if you look at it all, and I don't have this compares with the others, you know, is what goes into the defined benefit plan for Mark. Well, oh, no, well, actually, it's in the 401K now, so I strike that.
No,
Mark is part of the pension plan.
Mark's in the DB.
But he's.
No, he gets a pension on this salary.
But
Oh, I
not
know,
the original.
Isn't he now the 401K?
Not the original.
What's that?
He's in the plan closed for him, didn't it?
No.
Oh, that's right, okay.
He's
So
in
look-
one-
look, that's right, so, you know, look at that as part of his compensation. Yeah. That's nice.
Well, it's
I
not
assume the other ones
it's not
have
the
similar-
original plan. It's the 2009 plan, so it's not the same plan.
I'm going to make a, I'd like to,
Pre-2000.
since we don't have a second to the motion to increase Mark's pay by 3.5%, I'd like to make a motion to increase Mark's pay by 5%, and we'll see which ones get seconded and which ones get voted on.
Is there, Alan, this is your call.
Right.
Is there a second?
So,
Neither one's been seconded,
so you have a motion from Val
which has been seconded by Carol.
for a
5%
increase
in the base salary for Mark.
in Mark's base salary. Okay. So with that said,
What's that dollar amount?
11,500.
11.5
From 230.
off the 230.
from 227.
And what's the 3.5?
It's about 11 off the 237.
3.5
Versus what?
is 8,000.
8 to 11,000?
Okay.
It takes him to
So I have a motion
$238,000.
from Val, second from Carol to increase the CEO salary, base salary of 227,116 by 5%,
Beginning September 10th,
beginning September 10th.
2016.
So those in favor of that increase?
I think we wanted discussion.
I'm sorry, Jeff, did you want
Bill
to?
was trying to get your attention. Were you?
I was just going to comment. I couldn't. I'm not going to vote.
I understand that.
5%. Okay.
All right.
You want to tell
All
us
right.
again that you don't want to vote for it?
So those in favor of the 5% increase for Mark beginning September 10th, raise your hand.
It's 6 votes, so that's not enough to carry.
So that motion fails. We need 7 to take an action.
Is there any possibility of tabling this until we have a larger group, since we're missing one of our board members and we're going to be filling another board seat?
Val, we're going to have to because I know the results of the 3.5% vote. It's not gonna
Well,
pass
see, I
either.
will favor a 3.5%, but I would also favor a 5%. I'll favor,
Well, I won't vote for the 3.5 because I think it needs to be higher, not on a cost of living basis, but just on an issue. So I don't know how that works, but
so
I'm
we'll
not voting
deadlock
for
the
the
board
3.5.
then.
I
Maybe
think it's
that's
worth
the way
the
to go.
motion. I'll motion 3.5% increase.
I'll second it.
All right, so we have a motion from Jeff Wallace, second by Bill Hayner, to increase the CEO's base salary compensation of $227,116 by 3.5% effective September 10th, 2016. Did I get that right, Luli?
What happens if that doesn't pass?
He stays at his current salary level. We bring it back up at the next board meeting.
Yeah.
When there's a full board.
All those in favor of that motion, raise your hand.
Okay, that fails.
That fails. Two.
To
Yeah.
not
We
7.
went through it.
Okay.
Would you like to table this and we'll put it back on the agenda for November?
Sure.
Seems
Okay.
like we should be doing that.
Yeah.
Yes.
And I would
All right.
like to suggest, in the interest of time, we do the same thing for the chief compliance officer, because I know 3 of you have to run,
Yes.
That's right.
and we want to have an adequate discussion.
And they probably should be related.
Yes.
And is there any additional information you would want me to research in this next month before the next meetings that maybe I can have for you? And
I would like to see what the different plans are doing on the pension side, whether it's DB, whether it's 401K, what the other CEOs are getting.
I would like an actuarial analysis on the pay raises. That's not a joke, honestly. That is what occurs in the city. That is a practice that we use.
And I will tell you, I don't want to see that because I don't think it's relevant or applies here.
And that's not something that I would have the
have to pay
expertise
an
to do.
actuary to do it.
But I can certainly do the analysis on the DB versus the 401K. And I'm only going to go work with the agencies I'm working here. Is this enough agencies for your review? Everybody good with this amount? I've got low, high, and then I've got medium.
I think San Mateo and Marin are little high-scale neighborhoods.
I would like to see all 41.
I'd be in favor of more data rather than selectivity of data so that we can see everything.
Okay, but so 40, to survey 41 agencies, I mean, this would require months for me, so I,
No, but you have some data. I mean,
yeah,
if
I
you
have some
If you
data.
have a sheet with the data that you have for those and you survey what's currently on your list, I'm fine with that.
okay, so I'll do what, I can give you the data of the 41 agencies with the general information. I'll do a small chart for you, but what I will do on the DB and the 401K, I'm going to limit it to the agencies I've already gave you, because otherwise that's enormous.
That's fine.
Okay?
For me.
Great.
Perfect.
Thank you very much.
Thank you, Lily.
Thank you.
With that, we're adjourned.
Thank you.
Thank you, everybody.